Round of votes happening here in the UK with sovereign bonds, and this is ahead of one of the most interesting Bank of England decisions on Thursday. Tomorrow we have CPI data. You can see at the moment sterling 127.80. Now let's also check on what happens for treasuries, but also Alibaba, because we had a shake-up that was pretty much unexpected at the end of it, or at the end of yesterday's trading session. So Alibaba down 1.6%, the UK two-year yield 5.069. We have a full roundup from John Stepek, who says he doesn't believe interest rates will actually go to 6%, but he does actually tell us in plain English what happens to mortgages and so what it means also for your portfolio. Now, Chinese banks have cut their benchmark lending rates following a move by the PBOC. 1-year and 5-year loan prime rates have been cut by 10 basis points each. Now, investors' disappointment has driven stocks lower. So for more on all of this, we're joined by Sofia Ortega-Costa, our chief China markets correspondent, Bloomberg's Bruce Einhorn, both in Hong Kong. So, Sofia, why is the market actually disappointed with today's LPR cut?
Francine, there's a little bit of interest rate fatigue, because we've had so many moves from the PBOC, from banks to lower the cost of borrowing in China, when actually the problem is there is no demand to borrow. Credit demand is weak. So will it really move the needle? There was an expectation that maybe banks would cut the 5-year, that's the one that underpins mortgages, by 15 basis points. Instead, they delivered a 10 basis point cut. But, at the end of the day, there's concern that it doesn't matter how cheap credit is, it's not flowing into the real economy because households are still deleveraging, and that's the challenge for policymakers in Beijing, and this won't fix it. But the fact that it was lower than expected, at the end of the day, it's only 5 basis point difference. That does not explain why the market is so disappointed.
So, Sofia, if rate cuts are not enough, what's next in terms of stimulus?
So there was this expectation going into last weekend that the State Council, this is Beijing's key policy-making body, would at least, be more specific over how it plans to boost demand, because we've had a lot of rhetoric coming out from really top-level officials in Beijing saying that boosting consumer demand is a huge priority, but we haven't seen, a strong fiscal transfer, for example, into consumers' pockets. We don't have a plan. We don't have specifics. There is an expectation that more is needed. Maybe the PBOC will inject more liquidity into the financial system, which essentially means that banks can lend more. But again, there's a consumer confidence crisis, there's a market confidence crisis, and it remains to be seen whether any of this will be enough to really kind of boost that or reverse that, if you were.
Sofia, thank you. Let's also bring Bruce Einhorn on the politics. And Bruce, we're just getting some news from the Chinese premier saying, look, de-risking decisions should be taken by companies rather than governments. What does this tell us about Chinese leadership thinking in what companies should do next?
This could have a lot to do with what we're expecting to hear today from the EC President Ursula von der Leyen laying out the community's economic strategy, especially as it relates to whether to de-risk from China. The Chinese Premier Li Qiang is in Germany right now after he has talks in Berlin with Olaf Scholz and other government leaders. He is expected to go down to Bavaria, and there he's going to be meeting with the CEOs of Siemens, and BMW. Both companies have major presence in China and are in the process of expanding them. So the Chinese are still looking for ways to win over a lot of Europeans who are somewhat skeptical about China's relations with the European Union, especially following Russia's full-scale invasion of Ukraine. The Chinese have, of course, tilted toward Moscow in that war.
And Bruce, with Blinken's China trip, has it actually yielded the best possible result, which means more talks at least?
Yeah, they've benefited from very low expectations going into these talks, an indication of just how bad relations were. When Antony Blinken arrived in Beijing, the Chinese literally didn't roll out the red carpet. There were just some red lines on the runway for him to walk along, and there was only one official from the foreign ministry to greet him. So the results of the talks a few days later show that there are ways now for the relationship to improve. Secretary Blinken had meetings with several Chinese officials, most notably the meeting with Chinese President Xi Jinping. That was something that wasn't on the schedule. It was unclear whether he was going to have that meeting. The fact that he did get that meeting is an indication that the Chinese feel that the talks went well. President Biden, for his part, praised the Secretary of State, saying that he did a hell of a job. So what we have to look forward to, as you said, more talks. So the Chinese foreign minister is likely to be going to Washington sometime in the coming months. From the U.S. side, we're likely to see Janet Yellen, as well as John Kerry, the top climate envoy, travel to Beijing. All this could potentially lead to another meeting between the two presidents. President Biden and President Xi last met in November in Bali, and they haven't actually even talked since then. President Biden did say recently that he did hope to have another meeting with the Chinese president. The successful trip to Beijing by Antony Blinken does create the possibility of that happening.
So, Bruce, what were some of the challenges that we saw in the course of Blinken's visit?
Well, they didn't accomplish that much concrete, right? Because they did discuss some things like increasing the number of passenger flights between the countries, or things related to student exchanges. The U.S. didn't get the thing that it wanted the most, which is a commitment from the Chinese to renew military-to-military communications. The Chinese severed those last year after then House Speaker Nancy Pelosi made the trip to Taiwan, which of course angered Beijing considerably. So that's something that did not happen. They didn't get that commitment from the Chinese. On the other hand, there is the prospect of more meetings taking place, so at least it potentially creates what the White House and the State Department have called in the past a floor for the relationship. So prevent the U.S.-China ties from deteriorating further and potentially building from there.
And Sophia, what more can policymakers now do to try and support the economy if it gets worse? I don't know whether they need to play or do something for real estate or infrastructure, or whether there's something else that they're looking at.
Property is definitely the biggest drag. In terms of infrastructure, there's a problem, there isn't that much left to build when it comes to big projects, because, is a big bridge, is a big airport really going to move the needle? So what China is doing is actually focusing on smaller infrastructure projects that fit into, the EV, the greenification of the economy. So that will be in focus. But in terms of really, and I've been saying this for weeks, confidence is a very, very difficult thing to change, and especially when you have 3 years of COVID-0 to recover from, a property market downturn to recover from, a huge wealth effect from that. Let's not forget that households store their wealth in the property market in China, and to really get people spending again and to be comfortable about their future, that's a very, very big challenge for Beijing, when youth unemployment also is near 21%, and that's at a record, and is only going to get worse. So I do not envy a policymaker or an economic policymaker in Beijing right now.
So, Sophia, overall, when you look at some of the challenges, I know we're looking at numbers, the youth unemployed is really quite staggering. I think it's over 20%. Do we know if there's something that actually policymakers are looking at to trying to address?
Well, there are some initiatives that have been kind of floated around. The youth unemployment is likely to get worse because we have the summer season when, people graduate from university, and those numbers are going to tick up. But where are you going? Where does China want young people to work? It's no longer kind of the shiny tech firms like Alibaba, like Tencent, that employed a lot of these people straight out of high school. They want to kind of channel the talent into industries where it kind of fits with the priorities of the CCP and Xi Jinping, and that's high tech, manufacturing, anything that really sets China up for a future where it can compete against the US, and it can compete when it comes to that kind of technology. And Whether that will work, that's a long-term project. We're talking about decades, so we're not going to see that effect or that impact. Those initiatives really play into the economy this year. It will take a long time. So replacing kind of the growth driver of the property market, which has been a very, very key part of China's growth and infrastructure spending, where is that going to come from? That's going to come from investment in technology, and that's a project for the next decade.
Thank you both for joining us. Sophia Ortei-Costa and Bruce Einhorn, of course, covering extensively what's happening in China now. Coming up, UK short-term government borrowing costs have climbed. We discuss what impact that could have next. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open, everyone. 13 minutes into European trading day. Across the board, we're seeing a bit of pressure, down 0.3%. The longer-term question is actually what you do with some of the Fed pricing and what's happening in China. There was disappointment about what some of the banks have been doing. Now, the UK's short-term government borrowing costs have climbed past 5% for the first time since the global financial crisis. And that's amid concern that the troubling inflation outlook could lead to more aggressive monetary tightening. Now, let's get more with our markets reporter, Valerie Teitel. Valerie, it's a very simple call, which basically the markets think that the Bank of England have lost control of the inflation narrative.
Yeah, that's just a bad sign that the market is trading this way, Francine. The price action yesterday was very eye-catching. Not only did two-year yields break through 5%, but they went on to trade almost 10 basis points through that yesterday. And if we look at the correlation with what happened for sterling in the FX market, sterling didn't strengthen. That is quite negative for the outlook for UK growth, for if it can handle these extra rate rises the market wants to price in. If we delve a little bit deeper, though, on what's expected in the front front end when it comes to pricing for the Bank of England. We are near a 6% terminal rate when you look at front end SONIA futures. And not only that, we're now pricing in the chance of a 50 basis point jumbo rate rise at one of the next 3 Bank of England meetings out until September. Now, remember, Bailey is not shy when it comes down to talking down the terminal rate. He's done it previously, but the risk is now here that if almost Bailey doesn't meet the hawkish expectations that the market is pricing in, if instead he decides to talk down this terminal rate, saying he is confident that inflation will slow as in growth slows under these rate rises, the market could actually see that as negative, Francine. It could actually reject this idea that he's trying to push back on this terminal rate and think instead that the Bank of England has lost a bit of control, and it could actually lead to yields going higher. This is all going into the CPI print we have tomorrow and the Bank of England meeting on Thursday. It's going to be a big one to watch this week in Europe.
Yeah, it certainly is. And if you look at UK core inflation, some say it's yet to peak. What's Goldman's call?
Goldman made a very interesting call when it comes to QT. Now, QT has been going on in the UK for almost a year, and they're going to review the pace in September. Now, Goldman calls for the fact that they think the Bank of England will not be able to sustain this pace of QT and will have to drop it from 10 billion per quarter down to 7.5. Now, they think this almost in a very similar way to the reason why the Bank of England had to pull active QT during the Truss mini budget disaster, essentially, because the increased volatility led to such lower liquidity in the market. Goldman thinks that there is a risk that the Bank of England cannot sustain this pace and will have to lower it. Now, that being said, if we switch on to my next graphic here, that contrasts with what we've heard from the Bank of England recently, that the Deputy Governor Dave Ramsden, who suggested last month that gilt sales could actually increase when it comes to reviewing the pace in September. But all of this goes back to saying, Francine, that the street is concerned that this lack of liquidity, this increased volatility in the gilt market will have the Bank of England thinking twice if they look to increase this pace in the fall.
Valerie, thanks so much as ever. Valerie Teitel there, our markets reporter, looking at what the Bank of England can and cannot do. Now, Alibaba has unveiled a surprise succession plan to replace Daniel Zhang, announcing a new chairman and chief executive. They'll take over a company that's been bleeding market share and struggling to revive growth in the post-COVID era. Well, let's bring in Alex Webb from Bloomberg Quick Take, who looks at technology for more on this. So this is quite a shake-up, right, if you're going to put it diplomatically, and it was quite unexpected.
Yes, it absolutely was. The thing that's quite interesting in the middle of this is that Daniel Zhang was chairman and CEO. The new leadership team, Joseph Tsai will be chairman and Eddie Wu will be the CEO. Now, separating those two roles out. Now, you can sort of see some of the rationale for this, that they are breaking the company up into 6 different divisions. The cloud business potentially is going to be carved out completely, won't have any lingering equity stake from Alibaba. Daniel Zhang, the current CEO and chairman, is then going to head that business. But because the legacy Alibaba, as it were, is going to be more of a like old-fashioned holding company with equity stakes and things across the board, it makes sense to separate these roles out a little.
What does this mean for actually I mean, the company's been going through really troubled times. There are many, many challenges ahead. Does this help them in trying to figure some of those out?
Yeah, the thing that's fascinating about this is that the cloud business is really the fast growth bit. So by putting Daniel Zhang into that role, he's obviously led the rapid growth of Alibaba over the past decade. But in that core business, the e-commerce space, which is going to be what is remaining in old Alibaba, they're facing heightened competition in their domestic market. So we've seen, for example, ByteDance, the parent company of TikTok, which TikTok has said it wants to grow its e-commerce sales from 4 billion. I can't correct that. Bloomberg has reported that TikTok plans to grow its e-commerce sales from 4 billion last year to 20 billion this year. That's gross merchandise value. There's really mounting competition in that space. By putting the head of those businesses, Alibaba's own e-commerce businesses, atop the company, maybe he's better primed to compete in that space.
So what else do we know about how the strategy, I guess, could change for Alibaba?
Well, look, there's a certain amount of Kremlinology going on right now. Is this actually a sideways promotion for Daniel Zhang? Is there a sense that maybe they didn't think he was up to that job? Or is it just that actually, he's better at a fast growth business, driving that, and you need someone here who's really going to be, facing up to that competitive threat? A lot of people are trying to pass that right now, work it out. this reaction from investors has been mixed so far. We've seen some people going, great, that means that they can focus on strategy. Others going, actually, this is negative for the stock. I'm sure within a few hours, when we've had a bit more reporting, we'll have a clearer sense of it.
Alex, do we know who's calling the shots here?
It's very hard to tell. These are all people who are quite close to Jack Ma, the founder, but it doesn't really have a formal role of the company. He's still a big shareholder, of course. He's gently been eased out with, a certain amount of, as part of the broader crackdown on tech companies. I'm not sure if it was cause and effect, but in the process of China cracking down on its domestic tech companies, we saw Jack Ma gently, leave from a formal role. So they're all sort of the perception is they all sing from a similar hymn sheet to him because they come from the same school. They just don't have quite the prominence that he does.
Alex, thank you so much, as always, for coming on Bloomberg Quick Takes. Alex Webb, who covers technology for us. Now, coming up, we take a look at the stocks on the move this morning, including Lanxess. The stock slumping after the company lowers its outlook. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We don't have an option in terms of a fallback. As we've made it quite clear with the people we're working with, we don't have leases on existing aircraft. We can't slow down a network because we don't have a network. We absolutely have to have those aircraft delivered on time.
We see that there is a lot of businesses that want to go and see their customers. So they are flying in the front cabins of the airplane. And at the same time, there is a lot of demand for travel. For example, China. Every single seat in every class, and we only have 2 classes in my airline.
Yes.
It's full.
Well, Riyadh Air Chief Executive Tony Douglas and the Qatar Airways Akbar Al Baker speaking from the Paris Air Show to our Guy Johnson. Now, 24 minutes into the European trading day, a lot of the focus, apologies, there's a lot going on, so one loses one's voice. A lot of the focus, of course, is on China with exactly what's going on with the fact that policymakers disappointed a lot of investors by not doing enough to support some of the infrastructure through some of the banks. And the other big stories, of course, UBS. It's an FT report saying that the UBS is now facing a hit over Credit Suisse's Archegos debacle. So for the moment, UBS down 0.7%. Then UK grocers are getting a summer boost despite elevated inflation. That's according to Kantar. So let's also have a look at UK supermarkets. Tesco down 0.7%. With Ocado, there's a good story saying how a lot of people are falling out of love with Ocado. That stock down 3.2%. Let's see what else is on the move with our Joe Easton from our equities team. And Joe, you start with Lanxess, a specialty chemicals maker.
Morning, Fran. Exactly. So there's more pain this morning in the chemical space. We got Lanxess. Look at that, down 16% over in Germany after the company warns that their second quarter earnings will be exceptionally weak. They do note some customer destocking and also weakness in some markets that are usually pretty strong. So consumer staples, things like cleaning products, that's doing badly. And this is also hitting a number of peers, which I think we're going to bring up at the moment. I was looking earlier at BASF, Evonik. Here they are on the screen. BASF down 3%. Evonik also down. Covestro and Solvay. So all of these stocks getting hit. And this is even after we had a warning from Croda just a couple of weeks ago. So some of this was already priced in. But these comments seem much worse than analysts were expecting. Lanxess driving that whole sector lower today, Fran.
Then, Joe, you look at Lookers. This is a motor vehicle distributor.
Exactly. So this is a mid-size UK car dealership company soaring 34%. They've got a takeover bid from Canada. This is coming from Alpha Auto Group. It's 120 pence a share. That's 35% more than where the stock traded yesterday. And it's also lifting one of their peers called Pendragon. That was up about 6% earlier, now up around 3%. Now, the used car market has remained strong because supply chain issues meant that new cars couldn't be produced. That one's soaring, but chemicals slumping today.
Thank you so much, our Joe Easton there from our equities team. Coming up, the Chinese premier is in Germany as part of efforts to stabilize ties with Europe. We're live in Berlin with the very latest. That's next, and this is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Dijan Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
DOJ or other authorities
could face bigger challenges next.
was going to keep Green World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Hong Kong tech stocks sell off after Chinese banks disappoint markets with lower than expected cuts to lending rates, but Alibaba pairs losses after a surprise leadership announcement. The U.S. and China agreed to further high-level talks as Antony Blinken's Beijing visit actually wins praise from Presidents Biden and Xi. Plus, the UK's two-year yield climbs above 5% for the first time since 2008, ahead of this week's Bank of England rate decision. So first thing is first, let's check on some of the markets, and then some of the sectors are on the move. We're still seeing a little bit of pressure across the board, albeit we're off the day's lows. Now, if you look at the European stock 600, it's down 0.1%. We were earlier down 0.4%. Two questions. Again, inflation. Can central banks get a handle on it? So this is why we're seeing a lot of market movements when it comes to the UK markets ahead of the Bank of England decision. A lot of questions on the Fed. And then, of course, a bit of disappointment because the PBOC and other policymakers in China just did not do enough to support the economy. At least they didn't do enough. It wasn't as much as expected. So let's also take a look at the sectors on the move. If you look at commodities, it's one of the biggest losers over the last couple of days. Chemicals, basic resources, auto parts, still amongst the sectors that are losing the most in today's trading session. Then I have utilities, healthcare, and food and beverage on the up. Now, China's number 2 official is in Germany on his first overseas trip since becoming premier. It comes as Beijing attempts to prevent ties with Europe plunging to the lows reached with the U.S. Now, the premier, Li Qiang, met with Chancellor Olaf Scholz last night for dinner at the Chancellery. Now, for more on all of this, let's bring in our Germany correspondent, Oliver Crook, who's in Berlin. So, Ollie, good morning. What exactly is on the schedule today?
That's right, Francine, and it's going to be a busy schedule. It begins in about 30 minutes. Just behind me at the Chancellery is going to be sort of full military honors. Premier Leary will arrive. We'll have talks with Scholz at the Chancellery. That'll be sort of the more political focus. Then a press conference at 12:30, followed by then business talks in the afternoon at the Economy Ministry. You'll have CEOs there. There was already a preliminary discussions with about 12 German CEOs yesterday, mostly industrial sector. And really, this is a restart of bilateral talks that were begun during the Merkel era, but during a very different time. The Scholz government has yet to put out its comprehensive China strategy. Scholz himself has been a bit ambivalent about what this relationship looks like going forward. A lot of talk about de-risking without decoupling. Li yesterday spoke to German business leaders saying that actually the two are not incompatible. You can still cooperate while de-risking. Again, this is a fine path to walk, and one that is perhaps not as obvious as people would like it to be, particularly if you're running a business.
Yeah, so on the economic front, how telling is it that China decides to go to Germany and the premier goes to Germany on his first overseas visit and not elsewhere?
That's right, and I think that sort of highlights the importance of this relationship. And the Chinese Foreign Ministry really made a big deal about this, saying that Germany, it's no accident that this is his first stop. France will be the second, so read from that what you will. But this is a 300 billion euro relationship in trade last year. Obviously, this is absolutely, the Chinese market is the biggest market for Germany's biggest industry, the auto sector. And the question about, for businesses and CEOs, how they approach that relationship going forward, many of them are still investing heavily in China. Siemens, BASF, BMW, a lot lot of the automakers are still going fully in. But then the question is, how do you insulate yourself from possible risk? I thought it was interesting to see the news out from the FT yesterday, AstraZeneca looking at potentially listing its Chinese unit in Hong Kong as part of the insulation. So really the signals from this meeting will be closely watched by CEOs who are trying to make determinations about what this relationship looks like in the coming years.
Ollie, thanks so much. Oliver Crook, there, our Germany correspondent in Berlin. Now, sticking with German business, and by the end of the year, China's homegrown BYD could officially end, well, before year end, could officially end Volkswagen 2-decade supremacy in the country. But in the German car maker won't back down without a fight. Bloomberg's Oliver Crook has more.
Last year, a German car was sold every 6.7 seconds in China. It's the single biggest market for the big three, Volkswagen, BMW, and Mercedes. But the real opportunity is on the road ahead. Every single second, someone in China gets their driver's license for the very first time. And while in the US there are 84 registered cars per 100 people, in China it's just 23. So for China to catch up with the US, it would take 854 million cars. Since 1984, Volkswagen has reigned supreme in China, but sales are slowing down. And this year, EV upstart BYD overtook VW. By December, it'll be China's biggest car brand, officially ending VW's 2-decade reign of supremacy. Down the road, things look even tougher. When it comes to EVs, price is key. In the US, they cost 45% more than gas guzzlers. But in China, EVs are on average 33% cheaper than combustion engine cars. That's partly down to subsidies and unprofitable companies that just may not last. But Das Auto won't go out without a fight, ramping up its EVs to meet its competitors head-on. It's a race that matters a lot to Germany, where the auto industry is by far the single biggest part of the economy. It's worth almost $500 billion in revenue and employs 800,000 people. So Germany will have to steer a careful path if it wants to de-risk without destroying a fruitful economic relationship with China.
Now, U.S. markets reopened today after a long weekend in the U.S. Looking ahead, Fed Chair Jay Powell will give his semi-annual report to Congress on Wednesday. His testimony will be closely watched for any signals on the Fed's future rate path. Now, we're now joined by Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. Gina, thank you for joining us. You have some great reports. We'll push it out on social media, and congratulations to you and the team for always being out front. What is the biggest concern you have in the next 2 quarters? That earnings don't live up to expectations or something else?
Yeah, my biggest concern is that the Fed won't live up to expectations. I do think that earnings expectations are very grim and probably pretty easy to beat. We've seen not only did the market price for a really grim earnings situation coming into 2023, but analyst expectations continue to get worse over the course of 2023. So the bar is very low. We saw that in the fourth quarter earnings season where companies were able to beat expectations as well as in the first quarter once again. So I'm not that worried about earnings. What I am worried about is this sort of implied assumption in the market that the Fed will ultimately have the markets back. So far the Fed has complied with those expectations. The Fed did at least go on some form of a pause. Whether it's a pause or a skip is still up for debate, and it does infuse a degree of, yeah, exactly. What is this environment for Fed policy? What does it mean ultimately? And really importantly is, where's the trajectory of inflation? Right. Because inflation has been this huge boost to stocks this year. I think we underappreciate just how much that peak in inflation last year really contributed to much better performance in the equity market this year. So if inflation doesn't comply and forces the hand of the Fed to be tighter than the market is anticipating, I'd say that's probably the bigger risk.
So it's timing, right?
A lot of it is.
When this happens.
Yeah, it is. A lot of it's timing. And I think a lot of over the course of the last year, it's been about timing for the Fed, inflation, as well as the market at large. You know, I do think the market is saying, okay, look, we've been in this environment of tighter policy, fine, but at least the economy is not completely capitulating to that policy yet. And inflation is decelerating, which should allow for that policy tightening to ease over the course of the next 12 months. Ultimately, though, we get to this turning point later this year where it's not just about policy pausing anymore, but it's about market implied expectations of a Fed cut. And the Fed themselves is saying, hey, hold your skis here.
And
maybe we're not going to be able to get to that.
Also, right?
Exactly. And so that creates a degree of uncertainty that may create some volatility in asset prices.
Gina, I want to ask you about China, but first of all, why is there a bias? There seems to be a bias in the markets, right? That the Fed won't push the economy into recession. And I don't know whether that's memory, it's legacy, or they're just not listening to the Fed.
Yeah, so I think the bias in the markets is really we've had 15 years in which the Fed has been incredibly supportive of liquidity conditions, incredibly supportive of markets, really just tiptoeing around market performance in an environment where inflation was decelerating, flirting with deflation. The difference this time, if there is such a there's different this time, is that suddenly we're in an environment where inflation conditions are very different. The market itself is conditioned in an environment where inflation was decelerating persistently or really dampened, not a consideration that the Fed had to worry about. If they did worry about it, they worried about inflation being too low. And we've suddenly shifted in the post-pandemic environment to something very different. I think the markets are slow to catch on to that, and the implied action in the equity market this year has been, hey, guess what? 2022 was the anomaly. Inflation is not persistent. It's very clear that it was indeed transitory. This is indeed the market's perception, and we're going to go back to that former environment. So we'll have to prove otherwise, or the market is just going to naturally trade in an environment that it's accustomed to.
What do you make of China? So China keeps on disappointing in terms of the amount of stimulus that it's putting out there. We were expecting something more substantive to deal with infrastructure and deal with real estate. How much does that weigh on earnings?
Yeah, I think this is a huge question. I'm actually through Europe this week marketing with our China equity strategist, Marvin Chen, who's in from Hong Kong. And this is something we talk about extensively with investors, is what happened here? Right. Because I think as Europeans, Americans, the Western world came out of the pandemic, we saw consumers sort of enjoying their pandemic-related savings to a great degree. That created an economic rebound that was surprising everyone to the upside. China's been a completely opposite scenario, and I think that's a consequence of this sort of pandemic environment, which is very different in China than it was in the Western world. In China, the pandemic was more extended. The shutdowns were longer. They had a shutdown just last year. It created this lack of risk tolerance in the Chinese consumer base that we're now seeing in the economy. It's still something of a risk to earnings, though I do think with respect to the U.S. in particular, most of that risk is really concentrated in some of the multinationals and specifically in the tech stocks.
Gina, thank you so much, as always, for coming on. Gina Martin-Adams, our Chief Equity Strategist at Bloomberg Intelligence. Now, coming up, we speak to Andy Farrow, VP of Corporate Affairs and Sustainability at pet care and food giant Mars. Well, good conversation also on earnings. That's next, and this is Bloomberg. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that
get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
So world leaders are heading to Paris later this week for a major climate summit. We'll be speaking to some of the biggest names trying to address the climate crisis, including the French finance minister, Bruno Le Maire. Now, let's discuss more on the subject of sustainability. Pet care and food business Mars is one of the largest private consumer goods companies in the world. So its environmental plans make a big difference, a very big difference. I'm pleased to welcome the company's Chief Sustainability Officer, Andy Farrow, who joins us now. Andy, thank you. We've been trying to actually have a discussion, important discussion, a robust conversation on these types of issues. And there's a million questions that rise up. Are we actually less dedicated now to sustainability because of the rise in inflation, the cost of living crisis, and the politics around the world?
I don't see that. I see that that business is actually moving on a good trajectory. I think businesses recognize that the measures of success have broadened from pure financials to broader things in the world. And ultimately, if you don't tackle those issues, you'll have a bad time for business because supply chains will continue to be disrupted.
So this makes business sense, or is it also the good thing to do? And do you have government pressure, or is it shareholder? Well, not shareholder, but stakeholder.
Well, we have shareholders. You know,
stakeholder pressures.
I think it's a mix of things. I mean, it is undoubtedly the right thing to do. If climate change is an existential threat facing the world, and if you don't tackle it, then we will have huge issues. We as a company have the environmental footprint of a small country. And so it's important that we make a difference. Our shareholders, the Mars family, are very driven by it. And, we have 8 shareholder objectives. 2 of them are on sustainability, 2 of them are on trust, and only 4 of them are on more traditional financial metrics.
So how difficult is it actually to get, I guess, in these ever-changing supply chains? And we saw also, Secretary of State Blinken meeting with the Chinese president in this ever-changing geopolitical world. How difficult is it to get ahead of your supply chains?
It's difficult. I mean, 90% of our greenhouse gas emissions are outside of our own 4 walls. So while in places like the UK, we're at 100% renewable electricity, and we'll get to 100% all renewable energy without a huge problem. When you've got 90% that's in extended supply chains, 75% in agriculture, it's hard. We've made some good progress. Our greenhouse gas emissions are down 8% on their 2015 levels, despite a business that's 60% bigger. But 8% down, and you want to get to net zero. We've got a long way to go.
Out of your different products or categories, where is it harder actually to get greenhouse gas emissions lower?
I think it's not so much the categories as so much the hardest places in smallholder agriculture. So when you've got people farming on 1 hectare, 2 hectares, 3 hectares of land, it's very, very hard to get the transformational change that you need. And that's why we're really focused on 8 key things we buy and really making a difference there. And often when you tackle climate issues, you can also tackle issues of poverty, of human rights. So you get lots of things through doing that, but it's hard work. A good example on rice, we're a big buyer of rice. We have a big global rice brand. We're working with a farmer on a means of growing rice with alternate wet and drying that cuts methane by 40%. And methane is 25 times stronger than carbon dioxide. So, there are very practical programs on the ground that are making a difference, but a long way to go.
Andy, does it make a difference to consumers? So when I look at your packaging and when I look at some of the things you sell, do I know automatically that you're doing better than you were 2 years ago, and does it make me want to buy it more?
It depends on the product. We will have some labeling that you'll see on some of our products. It tends to be more on things that consumers more directly relate to. So we see it on packaging. We've launched the Mars bar in paper, for example, in the UK market. That's very obvious and clear, and that goes down very well. On climate, we see it, you'll see it in the corporate stuff. We do see our customers, by which I mean people like Tesco, people like Walmart, Sainsbury's, they are very interested in it, and I think it very much makes a difference to those conversations we have with them.
And so is it them putting pressure on you, or is it you having an offer that actually makes it, so appealing that they can't refuse to give you more business?
I think it's a combination. All leading companies are taking these issues seriously. We think very much that people need to be very focused on performance and not just commitments. And I'd love to see on shows like this, you spend a lot of time talking financial performance. I'd love to see much more reporting on environmental performance. And I think that's the way. Good.
On this show, we do, absolutely. But again, if it's easier if you're a private company, right, privately held, than if you're a publicly held IPO company. Do you see that conversation changing for some of these companies?
Yeah, I mean, I think it is changing. You look public and private. You'll say I was in Japan 2 weeks ago at the Consumer Goods Forum, where you had leaders from the retail industry, leaders from the CPG industry, and I think pretty universally on leading companies, people are setting targets. And we as a private company, our shareholders also want a good financial return. They're not choosing to say we don't care how you perform financially. You need to perform well financially and take care of the planet. And I think we've shown that you can do that. I think any company can do that.
We hear from various NGOs, various, of course, also stakeholders in the financial world, that what would help them is a price on carbon, worldwide pricing, or indices. What would make a difference that governments could try and get together to make a difference for you and for Mars?
I think the biggest thing the governments can do is have strong national plans. In the end, any company operates in countries, and so you want to see the infrastructure moving in a way that points out. We certainly want agricultural support to be focused on environmental benefits, not just sheer volume of food grown. So there are both areas that can make a big difference. I think ultimately carbon does have to have a price. And there are carbon pricing schemes in many parts of the world, but I don't think there is a single silver bullet that solves it all.
Okay, Andy, thank you so much for coming on. Andy Farrow there, Mars VP of Corporate Affairs and Sustainability. Coming up, Credit Suisse's legacy of legal headaches comes back to bite UBS, with the bank now facing huge fines from regulators. We'll have the details next, and this is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to the Open, everyone. 53 minutes into the European trading day. A little bit of a mixed session today. Earlier on, we saw a bit more pressure on the European stock 600 and investors really trying to figure out what the China disappointing news in terms of support for the economy meant for their portfolios. We're seeing shoots of green with the FTSE now 0.1% higher. Now, UBS faces hundreds of millions of dollars in penalties following investigations by several regulators into Credit Suisse dealings with Archegos Capital. That's according to a report in the Financial Times. Now, for more on all of this, let's bring in our Bloomberg Asia investing editor, Russell Ward, in Tokyo. So, Russell, good afternoon for you. Good morning if you're in Europe. What do we know so far?
Hi, Francine. Yes, this is just one of the many cases that UBS is inheriting following the completion of its takeover of Credit Suisse last week. In the case of Archegos, we know that Credit Suisse has been negotiating with regulators from Switzerland, the US and the UK over what happened that led to its massive losses, the $5 billion or more losses that it booked a couple of years ago tied to the collapse of Archegos. Credit Suisse has already admitted risk management failures to the Swiss regulator, FINMA, and also the Fed has said in its annual report that the Fed is already flagging that some financial penalties are in order. And so now what we're hearing from the Financial Times is that the Fed is looking at imposing penalties of around $300 million, and the UK regulator, the Prudential Authority there, is looking at imposing about 100 million pounds of fines.
So will UBS actually be ready to absorb these fines?
Yeah, I mean, I think UBS is ready for this. When it made this takeover, it set aside about $4 billion worth of provisions for litigation costs. We know that Credit Suisse is facing, the bank is, UBS is inheriting many cases that are ongoing with Credit Suisse, and Credit Suisse has intended to appeal many of those. One of the interesting things about this could be that whether UBS has the appetite to pursue those appeals and draw them out, or whether it wants to draw a line under them. But certainly there are litigation risks there. They've set aside the $4 billion. We'll just have to wait and see whether that is an accurate estimate.
Russell, thank you so much. Russell Ward there in Tokyo. Now, we'll have plenty more, of course, on UBS and Credit Suisse throughout the day. Also, a quick look at what stocks are doing before we leave you for Bloomberg Surveillance Early Edition. We're 56 minutes into the trading session. And, of course, it's the path of Federal Reserve interest rates increasingly uncertain that maybe makes traders vacillate between the lure of the rally and concerns it's exhausted. We'll have plenty more on the markets next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flat says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The U.S. and China agreed to further high-level talks as Antony Blinken's Beijing visit wins praise from Presidents Biden and Xi. Meanwhile, China's premier makes his first foreign trip to Germany. Hong Kong tech stocks sell off after Chinese banks disappoint markets with lower-than-expected cuts to lending rates, but Alibaba pares losses after a surprise leadership announcement. Plus, the UK's two-year yield climbs above 5% for the first time since 2008, ahead of this week's Bank of England rate decision. Now, first thing is first, so let's check in on the markets. A lot of the focus is, of course, what's happening in China and the fact that there was a little bit of disappointment with some of the policy measures that they wanted to put in place. The other question, of course, is what's happening with the Fed. Is this the time for, interest rates, I guess, being more uncertain than they used to, with traders really vacillating between the lure of the rally and at the same time concerned that the rally is actually exhausted and the market has become overbought. You can see that tension play out in the markets almost every day. Euro dollar 109.43. Now, something of a mixed picture for European stocks after they opened lower. Worries again about the Chinese economy, curbed risk appetite, and then we always look at politics as well. I think we're getting some live pictures of the Chinese premier meeting with Olaf Scholz right now. We could have, I believe those are live pictures. Look at that, right on cue. You can see the two side by side, and this is after we also saw the focus over in China with Antony Blinken being there earlier on. So we'll keep an eye, of course, on all of these live pictures. The body language seems to be friendly, it seems to be open, and we'll see whether that leads to a trade deal or at least some kind of an agreement to continue talking and investing. Now, joining us to talk about the markets and folding politics into all of this, Annika Beneby, Senior Portfolio Manager at Julius Baer, and Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. So thank you both for joining us. There's a lot to talk about. Annika, when you look at, I guess, the difference, which we're also seeing maybe a little bit of fraud in the markets, is one day they're up, one day they're down, is that they're really trying to figure out what the path forward for the Fed is and where inflation comes into this.
Yes, so I think the Fed being on pause is a very good thing. The more the Fed raises interest rates, obviously the higher the probability that it plunges the U.S. economy into recession. So my view is that the Fed has done enough. We're seeing inflation come down nicely in the U.S., and the pause needs to turn into a cease.
So what happens, and Gina, I mean, if the pause is into a cease, I mean, this is kind of what the markets need to grapple with day in, day out, right?
Yeah.
They kind of look at the Fed and they say, do I believe what the Fed officials are saying, which there's definitely no cuts, or do I have my inner belief that actually they won't crush the economy?
Yeah, I think it's a very good point. And if the pause does turn into a cease, As long as economic data is improving and or earnings data is improving, stocks can do just fine. They don't necessarily need to see an easing in order to perform relatively well. Certainly we've seen that so far this year. What is powering the equity market, in our view, is this deceleration in inflation, which is allowing for an earnings recovery after a very, very difficult earnings landscape of 2022. So as long as we continue to have decelerating inflation, we have economic growth, either slow or at least slightly positive, it probably does power some form of an earnings recovery into 2024. And I think that's what stocks are really grasping at this point in time. If we get that, we don't need a Fed ease, frankly.
We're also looking at live pictures out of Germany, and we talked a little bit about this, Gina, beforehand, is actually how do you view the China recovery that frankly has disappointed many investors. And as you look at these live pictures, for me, it's very telling that Germany invested some 10 billion for that Intel manufacturing plant in Germany. How do we see these industrial compositions change?
Yeah, I think it's a very good point. And certainly the relationship geopolitically between the US, China, as well as Germany and China is extremely consequential to ultimately resolving a lot of risk tension and geopolitical premium that probably has been embedded into stock prices since the war in Ukraine broke out. But in terms of China's economic contributions, it's been more disappointing for Chinese investors than any others in the world. Remember, China was a net drag on earnings growth globally throughout 2022, is already expected to be a net drag in 2023 after the disappointments so far this year. So I think China has the opportunity to upside surprise, frankly. Consensus is very grim toward China. Everyone came into this year thinking this is going to be the great play. We're going to get some growth out of China. We're going to see some earnings recovery, and that should power stock prices higher. We've had anything but that, and the net result is no one's expecting a whole lot. So I would say China has an opportunity to upside surprise, even if we get incremental improvements in this post-pandemic sort of era for them.
Yeah, and Annika, we have also, you have a new index looking at some of, how consumer behavior is changing across the world, and also some of your investors are shaping the world of tomorrow. What surprised you the most in what people are looking at right now?
So we have the Global Wealth and Lifestyle Report that Julius Baer launched 4 years ago. And it really looks at the cost of living well for wealthy individuals by tracking a basket of discretionary goods that they use every day. So everything from handbags to watches to private school education and residential property. We look at the cost of these items across 25 cities around the world, and we rank those cities in terms of most expensive to least expensive. And the most surprising things coming out of that are that people are future-proofing themselves. They're focusing on their mental health, physical health, future financial health, but also on the other hand, they're enjoying life. They want to indulge in spending, and we've seen an unabated demand for hotel suites, business travel, that sort of thing. Those prices have really skyrocketed.
All right, thank you both, Annika Beneby there and Gina Martin-Adams. Both stay with us. Coming up, the Chinese premier is in Germany as part of efforts to stabilize ties with Europe. We're looking at live images from Berlin. We'll have the latest on that next. And this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China's #2 official is in Germany on his first overseas trip since becoming premier. It comes as Beijing attempts to prevent ties with Europe plunging to the lows reached with the U.S. Now, the Premier, Li Qiang, met with the Chancellor Olaf Scholz last night for dinner at the Chancellery, and we're looking at live pictures, I think, from moments ago as he welcomes him back to the Chancellery. Now, for more, let's bring in our German correspondent, Oliver Crook, in Berlin. So, Ollie, we looked at the schedule last night. I don't know what else, if they're going down to business today, and actually we'll get some deals.
That's right, Francine. I don't know about deals. I think this is going to be more about signals and substance. And if it's about signals, let's inspect the scene that we've got behind me here to try to see what we glean from it. You have the German Chancellery. In front of it, you have the Premier from China with Olaf Scholz being greeted by military honors. Then just behind me here, you have the pro-China demonstrators. Out of frame, you have the human rights protesters, and then the sprinklers, I guess, to revive this relationship, if we can stretch the analogy. Because really, this is a Merkel-era initiative, these bilateral talks of the German government and the Chinese government. And now it's a very different relationship with Olaf Scholz sort of mix about what the future relationship is going to be with China going forward. It's obviously a huge economic imperative there, but really, if we could dig into the symbolism, as far as the Chinese are concerned, for Premier Li's first visit abroad, Germany is the first stop. This is meant to be significant. So if we want to open dialogue and sort of set the path for substance, this is what we hope for today.
So what can we expect on the economic front, Ollie?
That's right. So this moves all the action here. There's going to be a press conference at about 12:30 here. Then it goes down to the economy ministry, where there will be meetings with business leaders. The Siemens CEO will be there. There were 12 CEOs that met with the delegation yesterday. And in that meeting, Premier Li was saying that basically the sort of de-risking imperative is not incompatible with continued cooperation. And for German companies, that's really going to be the struggle. This is a huge economic relationship for Germany and for China. 300 billion euros worth of trade last year. It is China is Germany's biggest trading partner, and in the other direction, in Europe, Germany is China's biggest trading partner. So really the question is, for CEOs, where there's this ambiguity about what the relationship is going forward, all of the signals will be watched closely for the decisions they need to make going forward. I thought it was interesting that yesterday, the FT reporting that AstraZeneca looking to spin off its Chinese unit to try to insulate itself potentially to the risks associated with that.
Ollie, thank you so much. Oliver Crook, their Germany correspondent in Berlin. Now, sticking with German business, by the end of the year, China's homegrown by year-end could officially end Volkswagen's 2-decade supremacy in the country. The German car maker will not back down without a fight. More from Oliver.
Last year, a German car was sold every 6.7 seconds in China. It's the single biggest market for the big three, Volkswagen, BMW, and Mercedes. But the real opportunity is on the road ahead. Every single second, someone in China gets their driver's license for the very first time. And while in the US, there are 84 registered cars per 100 people, in China, it's just 23. So for China to catch up with the US, it would take 854 million cars. Since 1984, Volkswagen has reigned supreme in China, but sales are slowing down. And this year, EV upstart BYD overtook VW. By December, it'll be China's biggest car brand, officially ending VW's 2-decade reign of supremacy. Down the road, things look even tougher. When it comes to EVs, price is key. In the US, they cost 45% more than gas guzzlers. But in China, EVs are on average 33% cheaper than combustion engine cars. That's partly down to subsidies and unprofitable companies that just may not last. But Das Auto won't go out without a fight, ramping up its EVs to meet its competitors head on. It's a race that matters a lot to Germany, where the auto industry is by far the single biggest part of the economy. It's worth almost $500 billion in revenue and employs 800,000 people. So Germany will have to steer a careful path if it wants to de-risk without destroying a fruitful economic relationship with China.
Still with us, Annika Beneby, Senior Portfolio Manager at Julius Baer, and Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. So thank you both for sticking with us. Gina, when you look at some of the value in European equities, I keep on being told, well, look, U.S. investors find Europe uninvestable at the moment.
Okay.
And so there's maybe a little bit of catch-up in terms of valuations or some of the pockets of growth that you could see.
Yeah, and I don't know if U.S. investors find Europe uninvestable, but they have been captivated by a trend in the U.S., and it's called AI. In addition, we're starting to see broadening gains in the U.S., so the market has been so powerful so far this year that it's generally capturing most of the U.S. investor attention. That said, when we run our global scorecards, where we relative rank all the nations around the world, we relative rank the super regions as well, Europe does pop toward the top of our scorecard. Europe and Japan are toward the top of our developed markets outside of the U.S. rankings right now, whereas Canada and Australia are toward the lower end. Part of this is due to the fact that Europe and Japan are generally net consumers of falling commodity prices. So as commodity prices fall off, as inflation pressures ease, those economies tend to perform generally better and the earnings outlooks improve. Whereas somebody like Canada and Australia are very levered to commodity prices in their earnings stream, and that becomes a drag. But you're absolutely right. Valuations are incredibly attractive around the world. We just haven't had a big catalyst to drive funds into Europe. Normally, you would see that catalyst emerge with something like a currency transition. We haven't seen that. Some sort of breakout in economic growth or massive deceleration in inflation or a policy ease, which may be the next possible catalyst. We'll see, but generally they do rank quite favorably relative to the rest of the world.
Do you break it up in industries? Actually, when you look at, through your research, if you're a luxury group, of course it's different than if you're like a general consumer goods company.
I think this is an excellent point because the concentration in the European market is quite different at the sector level than it is in, say, the U.S. market, where the U.S. has been able to lever some of the industries that are most exposed to inflation deceleration as well as overall growth prospects for technology. The U.S. market, being incredibly market cap sensitive to tech, generally puts it in a better position at this stage in the cycle with that as the next catalyst for growth. Europe has less exposure to tech, much more exposure to the consumer, and thus is also very sensitive to wealth conditions and overall improvements in the markets and asset prices. Now, as we've seen so far this year, asset prices are improving pretty materially. If we can get some stability in property markets and other factors that tend to drive consumer confidence, that could be very good for European equities. Also, industrial companies, though. Germany's a very industrial-centric country. If we can get some improvement in industrial growth, say a trade relationship or a trade agreement comes down the pike, that could improve the prospects quite materially for Europe.
So, Annika, how do you build your portfolio? Is it through industries and actually trying to capture some of that growth in the growth spots, or is it really region by region?
So it is bottom up. We take into account sectors, but also diversified geographies. For the moment, we are more positive on the U.S., for example, because of that exposure to those mega cap tech stocks that have been influenced in AI. We think that that trade and that rally has some ways to go because we have seen earnings upgrades, but those earnings upgrades are also spreading to other sectors. So I think we're going into a good earnings season, and we could see equities go higher, generally speaking. In the U.S., we do like I mentioned, that technology, but we cushion that with some defensive exposure. So healthcare, for example, on the back of that demographic story.
Is AI in a bubble? I mean, we're kind of trying to call it, everyone's talking about AI, right? There's like this race to try and find the next NVIDIA. Do you worry that it looks a bit frothy or it's priced to perfection?
I don't think so. So this is not a situation like we had in 2000, for example. That was on euphoric multiples. This is not that. We're actually seeing the earnings upgrades. Most of that rally has come from earnings and fundamentals rather than multiple expansion. And so I think, we still have some room to go, and it's not a bubble.
And again, when you look at, again, portfolio building, are there emerging markets that you like above others? And is this sustained on fundamentals, or is it just capital flows?
Yeah, so there's a lot of talk around China, obviously, at the moment. The weakness in that data. We see weakness in the property sector. Certainly, developers are completing projects, but they're not starting new ones. And we have consumers in China who are still quite cautious. They're not borrowing. And so the policy that the government is implementing is the wrong policy. Cutting interest rates is not going to get people to borrow when they're in the course of deleveraging. So all of that to say, we would probably take a wait-and-see approach to China at the moment. India is probably one of our more preferred emerging market calls.
All right, so thank you both for joining us. Annika Benenby, Senior Portfolio Manager at Julius Baer, and Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. Now, coming up, the UK's two-year yield climbs above 5% for the first time since 2008, so we tell us what that means for the BOE, and this is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK's short-term government borrowing costs have climbed past 5% for the first time since the global financial crisis, amid concern that the troubling inflation outlook could lead to more aggressive monetary tightening. Let's get more with Bloomberg's John Stepek. So, John, if you look at, first of all, thank you so much for coming on yesterday, because it's got loads of social media views as people try to figure out what's happening with their mortgages. But what's causing the gyrations in gilt markets?
Well, it's all down to inflation again.
Yeah.
So, a month ago, the market was pricing in peak rates of 4.75%.
Yeah.
So effectively thought the base rate rise this week would be the last one, and then it would be on the way down. And as soon as the inflation data for April hit the wires in May, everyone suddenly, essentially, the expectation spiked. And then that was confirmed by unemployment data, which has been much stronger than expected as well. So the labour market's running much hotter. Wage growth's been much stronger than expected. And so that's it. It's basically because inflation expectations are much higher. There is a tiny sort of technical point about, because the Bank of England is also currently selling gilts under its quantitative tightening programme. It's much harder to see the exact effect that's having, but it probably doesn't help. But overall, it's very much about inflation.
But so, John, so you don't think, and you're one of the outlier calls, right? You don't think interest rates go up to 6%, but the market is tending to go that way because they believe basically that the Bank of England has lost control of inflation. Does it come to, I mean, is that the simple kind of, they've lost confidence in the Bank of England?
It's that straightforward. There's a loss of confidence in the Bank of England. There's also a loss of confidence in there's a sense that Britain is an outlier,
yeah.
And that there are various special reasons that the UK's inflation problem is worse.
Yeah.
I'm still not convinced that that's the case, I have to say. I think a lot of the headline inflation is definitely down to the energy price cap,
yeah.
And we'll see a lot of that drop out come July's figures. And I also think that if you look at individual countries in Europe, there are actually quite a few that have similar problems to us. On the one hand, you get Germany's in a recession just now, so it's going the other way. But Italy, for example, has got similar sort of inflation to the UK. So there are lots of issues, but I think that the UK is sort of being singled out.
Yeah, I mean, the UK also has, I guess, a deficit problem, right? Is that it probably needs more investment to grow, but where's the money coming from?
But, yeah, well, you see, this is the problem. So, there's lots of people with lots of great ideas about how, we should be using pension fund money, etc., to try and channel more growth into the UK and more investment. But the big problem is at the moment you've got, not only have you got a massive kind of government deficit, you also have the highest tax burden in decades, since the Second World War. That's not that conducive to investment. In an ideal world, you have a lower tax burden, less regulation, and instead what you've got is arguably, those are all difficult things to put into place. We currently have what I think is fair to describe as a lame duck government, which can't do those things and instead is looking at short-termism.
John, thank you so much. As always, clear, crystal clear from John Stepek. Coming up, Bloomberg has learned that UBS faces hundreds of millions of dollars of fines. More on that next. So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Hong Kong tech stocks sell off after Chinese banks disappoint markets with lower than expected cuts to lending rates, but Alibaba pares losses after a surprise leadership announcement. The U.S. and China agreed to further high-level talks as Antony Blinken's Beijing visit wins praise from Presidents Biden and Xi. Meanwhile, China's premier makes his first foreign trip to Germany. Plus, the UK's two-year yield climbs above 5% for the first time since 2008, ahead of this week's Bank of England rate decision. Also, today is World Refugee Day, a day designed by the UN to honor refugees around the globe. By the end of last year, more than 108 million people were forcibly displaced as a result of persecution, conflict, violence, or human rights violations. So today, we think of them. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Turkey's Treasury and Finance Ministry has indicated he will take gradual steps in steering towards more conventional policies as the nation looks to restore investor confidence. Now, sources say that adjustments will be made slowly to avoid unwanted side effects. Economists thought, though, expect rates to be raised steeply at Thursday's central bank meeting. Yesterday saw Turkey's benchmark stock index fell some 3.8%, the biggest drop in a month. Turkey hikes minimum wage by 34%. That's according to a minister. So again, the Turkey hike has increased minimum wage by 34% to deal with inflation. On to the banks now. And Bloomberg has learned that UBS faces hundreds of millions of dollars in penalties following investigations by several regulators into Credit Suisse dealings with Archegos Capital. Joining us now for more from our Bloomberg Breaking News desk is our editor and finance reporter, Leo Kencherper. So, Leo, thank you so much for joining us. I mean, these are huge fines. They were reported by the FT. I mean, they're like hundreds of millions of fines. Will UBS pay them?
Yes, it most certainly will. And it's important to note that they already earmarked $4 billion for potential legacy issues from Credit Suisse. So in theory, they should cover them. The only thing that's uncertain now is how much of that $4 billion is actually earmarked for Archegos.
Right. So what does that mean going forward? Again, is it something that they were expecting, or is this a surprise for UBS?
I think it's largely expected, and our BI, Bloomberg Intelligence analyst this morning, pointed out that more than $1 billion would be unexpected, so that's largely expected now.
So, Leo, UBS has inherited more legal cases when it took over Credit Suisse. Is there anything else that we should be looking out for?
Yes, there's two examples that I would like to flag. One is Greensill. Of course, Credit Suisse is trying to recover money from its investors that put funds into supply chain finance funds that were sourced via Lex Greensill, the financier whose business also went down 2 years ago. And that's probably going to drag on for a few more years. And then another most recent example is AT1s, additional Tier 1 debt. And some of the owners of this debt are now suing. And the odds are quite low. I think that's fair to say, but it's certainly a distraction.
Yeah. Okay, Leo, thank you so much for the roundup. Our Bloomberg Breaking News editor and finance reporter Leo Kencherper joining us on this UBS and Credit Suisse surprise. Now, Alibaba has also unveiled a surprise succession plan to replace Daniel Zhang, announcing a new chairman and chief executive. They'll take over a company that's been bleeding market share and struggling to revive growth in the post-COVID era. Let's bring Catherine Lim, head of Bloomberg Intelligence Asia Pacific. Catherine, so good morning, good afternoon. What's behind the shakeup?
Right, really, I think the move really aligns the management positions with the new structure that was announced a month ago. whereby essentially Alibaba is going to be a holding company, and that's going to be primarily driven by a lot of the e-commerce businesses, particularly if you think about, how they're going to be raising, funds for units like the cloud business, logistics, etc. So Alibaba's stake in these non-e-commerce businesses is going to be diluted, and really the bigger contribution to Alibaba going forward will be coming from all its e-commerce business. So it does make sense to actually have a new representative of this e-commerce businesses to come up as the new CEO and to actually drive, the holding company going forward.
So, Catherine, what does it mean actually for some of the challenges that Alibaba has really had to face with which, frankly, they haven't really recovered since COVID, and how they will be addressed in the future?
Sure. Now, of course, this management move doesn't change the fundamentals of the company. Essentially, they are still facing increased rivalry from social media platforms like Douyin, the Chinese TikTok, as well as Kuaishou, etc. So I think going forward, what is on the shoulders of the new management team will be to really prove that they will be able to defend their existing market share going forward. And it's interesting that, just about half an hour ago, the company held an analyst call, and it's actually really interesting hearing how the up-and-coming CEO has a technology background and can actually help breathe new, innovations on technology into the existing e-commerce business itself. So that's the thing I would really be watching out for.
So, Catherine, who's calling the shots here? Is it the Chinese government or is it private stakeholders?
Right. Well, this is still a publicly listed company itself, and of course, Alibaba is going to be mindful of the regulations that the Chinese government has put in place, both the internet sector as well as, particularly when it comes to generative AI and new technologies in the market. So they're going to be abiding the rules, but they're going to have to actually, innovate and, hopefully their independence, as a private company can actually spear some of the innovations that we will see in the future.
All right, Catherine, thanks so much. Catherine Lim there from Bloomberg Intelligence on Alibaba. Now, another story we're following today, the U.S. Coast Guard and other rescuers are racing to find a submersible diving vessel with 5 people aboard that's missing in the North Atlantic on an expedition to view the Titanic shipwreck. The Coast Guard received a call on Sunday saying contact had been lost with the vessel about 900 miles east of Cape Cod. Now, the missing submersible carries a pilot and 4 crew members to a maximum depth of 4,000 meters. Coming up, thinking of moving abroad, well, Monocle magazine has revealed its top cities for quality of life. We'll bring you the details next, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has 2 targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, for those of you looking to move abroad, Monaco has released its quality of life survey. With low crime and excellent transport system, Vienna holds the top spot. Now, all of the top 5 cities for quality of life are in fact in Europe. Now, joining us now is Tyler Brûlé, editorial director and chairman of Monaco. Tyler, make us dream. So it's Vienna, but how surprising is it that it's European cities that come up on top?
Good morning, Francine. Not so surprising, because we've discussed this over the years. One of the things that many European cities benefit from is that they were planned, they were developed, the infrastructure went in maybe at the right time. They were built right the first time. So Vienna, of course, once recognized as one of the capitals of Europe, maybe not surprised that it had all of the elements in place, the tram networks, when the metro was developed, the airport as well. All of this, of course, serves the city in a very good way. Not to mention, much of quality of life is about the quality of housing stock, the neighborhoods, all of these things. So that's one of the reasons why Vienna came out on top. But you mentioned those top 5 cities. It's a super tight race because Munich also doing a great job. Zurich also doing a fantastic job as well. Maybe Stockholm, number 5, could have been a little bit higher. And one of the things we look at this year is the issue of violent crime. And that's one of the striking things, because it's the first time since we launched this in 2007 that no U.S., or actually no North American city, has made it into the top 20.
Yeah, and this year there was a special focus that you put on, of course, on security. Does that change? I mean, I was surprised, for example, that Vienna, number 7 last year, now number 1. Munich, number 11 last year, now number 3. So how much efforts can actually city mayors put in place to change some of these rankings?
I think they can do quite a few things, and it's always interesting. There's I would say sort of towards the end of the year, start of the year, there's a lobbying moment that happens when cities want to talk to us about what have they done with infrastructure, what have they done from a security point of view, what new museum have they attracted to come to the city. But I think that's, in a way, sometimes that's also where the message is a bit misguided, because, yes, museum is great in terms of cultural input, but is it somewhere that, of course, residents are going to go every day? I'm sitting, of course, here in Milan this morning, and if you just go beyond the Bloomberg windows here, I mean, you know what the crush of tourists are like. And of course, we need tourists for dynamic economies, but at the same time, we also know that a lot of European cities in particular are very much under pressure. So this idea of of having sort of these great cultural monuments, great idea, but it also has to, I would say, be in lockstep with what the electorate wants as well.
I think we sat down, went through the list, and I think 3 of my team are moving to Tokyo, 1 to Helsinki. I have 1 wanting to move to Sydney after your quality of life ranking. Has this changed because of COVID, Tyler? We talk about working from home, but do people want to live in better cities?
They do, and I think, of course, people have the ability now, Francine, of course, to work remotely, or they can also maybe up sticks with their top management as well, and of course relocate. So there is absolutely a race on globally. I mean, it's not a new one, but certainly COVID has helped reshuffle the deck, and certainly you see that in our ranking as well.
Yeah, how's Milan doing? You joined us from Milan today. I mean, they've cleaned it up. They're trying to attack finance, also with tax incentives.
Yeah, Milan, it climbed. It was sitting in the 20s. It's now at 18 this year. And again, this is a city which is really, is booming. You see a lot of people moving here. Of course, Linate, never sort of a loved airport. Now people think, wow, fantastic, an airport close to the city center, one which has also been redeveloped as well. So, this has, gone some distance, but also you have, of course, access to the mountains, access to the sea from here. So there's been, I think, a big relook at the city, and it's probably one of the cities, Francine, as well, which has really done a very good job. When they had the expo here, it wasn't squandered. You saw a lot of sort of great infrastructure go into the mix, into the city, and that is why it holds the position it does now.
Tyler, I just love what you put in some of these city winners like survey, right? Because you have whether you can get a good meal after 10 p.m. I mean, who does not need a good deal after 10 p.m.? Even, I would add, if you wake up at 3 in the morning because you work for Bloomberg TV, but also accessibility of public swimming spots. Has what we, do we want different things from our city now?
Yeah, absolutely. I think that, I think commuting is obviously a huge component around this, and that is, a nightmare. So I think obviously cities which have got good infrastructure, cities where, of course, they're walkable, where you have a good cycling infrastructure, which is not forced. Of course, you see cities like, I was in Toronto recently, a big discussion about the cycling network there, partly because it's not used for most of the year. It's still very much a car city. And, do you want to be on a bike in Toronto in the middle of February? Probably not. So I think there's, again, you see a number of things. I mean, you're off to Zurich next week. I'm based in Zurich. There, the lake, I mean, the transformative power of that lake, all of the swimming clubs, of course, goes very far when people think about where they want to live.
Yeah, and I don't know how much time you think, Tyler, about, reorganizing some of the office buildings, about how people, again, maybe they've abandoned some of the business hotels and how some of these can be regenerated, and whether that's the big question, including, of course, how to house the homeless in the next couple of years, whether those are really the real issues that mayors have to tackle.
Absolutely. I mean, these are, of course, key elements. And with it, of course, comes, we have to address also the social, issues that come with it, the security issues as well. If you can't get a grip on the fundamentals, you can deploy all of the police that you want and all of the anti-terror barricades, et cetera. But if you don't get to the root of the problem with homelessness, why people are displaced, then, of course, it spirals out of control. And that's, it's really one of the things that when you look at the challenges that, many North American cities have at the moment, it's actually not tackling the fundamentals. I mean, we can talk about and have a discussion about policing, but there are many things that have to, of course, happen at ground level, which, simply aren't occurring, or certainly there might be attempts at a fix, but certainly no one's come up with a remedy yet.
Tyler, have the people that actually have fled big cities during COVID come back to big cities?
I think, yes, I do see that. I think there has been a return, and it's interesting. One thing we have to sort of address here is that the world is not flat. I mean, of course, here we are on Bloomberg broadcasting across the world. I think a lot of people think that the world, is the whole world like San Francisco, or is the whole world like New York? And that's certainly not the case. Singapore is functioning in a very, very different way and you could say the same of Hong Kong than versus Paris or versus Boston. But I do think that you have seen a return to cities. City centers, maybe not, or at least not in North American cities. And I think that's one of the big challenge that mayors have, when they look ahead. How are you going to, it's not about getting people back into the offices, but what are you going to do with all of these derelict spaces?
Tyler, as always, thanks so much. Tyler Brûler there, editorial director and chairman of Monaco, with this really great quality of life survey. I think it hits the stores on Thursday. I had a copy of Monaco, but it was, of course, taken from me as somebody wanted to read it as soon as I walked in. Coming up, we're live at the Paris Air Show, where airlines have been boasting record deals. More on what that means for the industry next. And this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Each exogenous shock is unique. It's tempered me on how I approach labor on the forward-looking view. I think we're going to be a little more conservative on that. But each crisis, you got to stare into and decide, how do you manage this company moving forward?
As you say, the supply chain's coming back. I understand you're talking about the fact you're going to take the 737 line up to 38. When is that going to happen?
Look, soon. I'm not going to give you an exact date, but it's
This year?
Absolutely within the year. And we're very near that moment.
What's the next milestone
we're running
after
at 31. We're about to go to 38, and then we'll look at a break in the 42 before the end of the year.
Before the end of the year, you think you'll be at 42?
Yes.
Okay. Let's talk about what else is going on. You've got a 767 program that is going to struggle with ICAO regulations, the emission regulations that's coming up. You've applied for an exemption on that. Does that mean I'm not going to see a 787 freighter anytime soon?
Look, I think the 767 today on the environmental front does a great job in terms of per ton delivering the right emission answer. In the future, we'll look at other variants. The 787's the next natural act because it's got the right size, it's got the right
If you don't get the ICAO exemption, do you go straight for it?
Well, look, we're looking at it, but right now we're very focused on the 67 as the next solution.
Let's talk a little bit about kind of what comes next. This is an industry that is going to be supply constrained for a while by the looks of things. Is that something that you are going to use to your advantage? It was really interesting. The car industry during the downturn learned that it could make fewer cars and make more money. Does that apply to the aerospace industry as well?
Well, I think what we look at is, what the long-term demand needs to be, and then we have to factor in what can the supply chain do.
Yeah.
We've always tried to be conservative in terms of net output, not to overproduce to the market. We know that is bad for pricing.
Yeah.
And we're going to be responsible on responding to demand. And it's got to be done within the capabilities of the supply chain. So I think the long and short, we want to try to run right at demand or slightly under as a Boeing company. Never overproduce, keep the financial viability of the assets there for the airline and those who invest in these assets.
Am I going to see a big order today? Am I going to see a big order tomorrow? Am I going to see a big order this
I think
week?
you'll see orders at the air show, Guy.
Boeing orders?
Boeing orders.
Big Boeing orders?
We're going to see some nice orders.
Well, Boeing's head of commercial operations, Stan Deal, they're speaking to our very own Guy Johnson exclusively at the Paris Air Show. Well, more from the show now. The event has already seen a flurry of huge deals, including the biggest plane order in history from India's Indigo for 500 of Airbus's best-selling A320s. Now, some industry veterans are warning that some airlines are at risk of over-ordering and that a more cautious approach is needed. Bloomberg's Guy Johnson joins us now. Guy, you're the absolute expert in this, and you've done some really fantastic interviews on the ground. Are we seeing a bubble in aviation?
There is certainly that danger, Francine. We're seeing some huge orders. We saw that Indigo order, the biggest order ever placed. So there is certainly a risk that airlines might be over-ordering. Now, the reason they're over-ordering, there are different factors at play here. There is serious concern that the availability of slots from Airbus and Boeing are going to be limited for quite some time. So you want to get your place in line. You want to make sure that you're actually going to get some aircraft so that you can grow your business. And I think there's certainly a little bit of fear around that. So airlines may be over-ordering. What I think is going to be interesting here is whether or not Airbus and Boeing, and you just heard Stan Deal from Boeing talking about this, maybe they're going to take a more cautious approach. What you may see is limited capacity constraining the airlines, and ultimately that producing a smoother curve in terms of the growth story that we're going to see here, but potentially a more sustainable growth curve as well, because the airlines can't get all the aircraft they need right now, and as a result of which we may see the cycle longer. But at some point, there is a danger that all this over-ordering does lead to a glut of aircraft in operation, and that could see prices coming down really quite sharply. The other factor you've got to bear in mind in all of this, Francine, is how the pricing environment is working. Airbus and Boeing are going to be working really hard on this. They're going to be selling, they're taking orders now for aircraft they're not going to deliver potentially for another decade. How do you factor in inflation? How do you factor in what's going to be happening with inflation 10 years down the road into your pricing model? And all of this is really complicated in terms of the financial engineering that we're seeing right now, which makes some of these deals really difficult to do, and that's why they're coming right down to the wire in terms of when they're going to be announced.
Guy, thank you so much. Of course, we'll get more from Guy to see whether there's a risk that this over-ordering also means a little bit of headwinds in other parts of the supply chain. Now, get all of the latest from the Paris Air Show and everything happening in the French capital from our new newsletter. Scan our QR code to sign up to the Paris edition newsletter so you don't miss out on weekly updates in France's finance industry. Now, stay with Bloomberg TV, as we'll also be speaking to the Airbus chief executive, Guillaume Faury, and the Raytheon chief executive, Greg Hayes, later today. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials.
Connection lost.
Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Global stocks decline as U.S. markets wake up from a long weekend. Concerns over the weaker than expected stimulus out of China weigh on investor sentiment. Thawing tensions, U.S. State Secretary Antony Blinken's meeting with Chinese President Xi Jinping restores communications between the two countries after months of heightened tensions. Both sides vow to continue with more high-level visits to come. And UBS is reportedly facing hundreds of millions of dollars in penalties over Credit Suisse's dealings with Archegos Capital. Imposed fines may come from U.S. and U.K. regulators, according to Bloomberg reporting. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Kriti, so great to join the Early Edition team and joining when the talk of the town is, are we in a new U.S. bull market?
Yeah, day one for Danny Berger. We're excited to have you. I think you completely nailed it here. Are we in a new bull market? Yet we're still dealing with a lot of concerns. There's still a lot of doom and gloom out there. And Danny, of course, we get paid in the media to really accelerate that doom and gloom, if you will. You are seeing it from the Federal Reserve. You're seeing it from geopolitics. You're also seeing it from China, which is, I think, where you are expecting to see a little bit more of the market read through. I'm going to start from the bottom up here. For our radio audience, stick with me. Overnight, we saw the Hang Seng Index drop by about 1.5%. Essentially, you hit it, Danny. This idea that the Chinese stimulus that a lot of people were expecting did not come through to the same extent that they really wanted. And that is weighing on sentiment around the world. You are seeing futures as a result down about 0.4%. But remember, geopolitics is baked in there as well. U.S. and Chinese kind of government officials meeting over the weekend. Some are saying that there's progress. Others are saying not so much. Anyways, regardless, the lack of progress perhaps is also going to be weighing on sentiment. But then you have to factor in the bond market, the Federal Reserve. Remember, a lot of these bets on more of a hawkish Federal Reserve are kind of ramping up, which brings me to the two-year yield of about 4.72, unchanged at the moment. But really keep an eye on this one because it's getting closer and closer to that 5% terminal rate on the front end of the curve, which tells you that as you start to see some of these hawkish bets getting priced in further and further into the year, the two-year yield is probably going to get higher and higher. And again, we are seeing it creep in that direction. Also worth noting that around the world, you're seeing a similar story, this conversation between hiking and pausing. Overnight, Danny, we also got a message from the RBA. They released their minutes and essentially revealed that, well, there was a conversation about pausing instead of hiking. And remember, 2 weeks ago, we saw the RBA and the Bank of Canada kind of make waves by making those hawkish bets. But apparently, a pause was on the table. Nevertheless, that pushing the Aussie dollar down by 0.8% against the greenback. It is the biggest weight on the Bloomberg Dollar Index at the moment, which at the moment is unchanged, Danny.
And we are looking at another negative day here in Europe. Kriti, yesterday we didn't have that impulse from the U.S. Open to lift European equities. That's a lot of times what we see. It's a negative session in China, a negative session in Europe until the U.S. comes online. Will that change today? For now, Again, we're just kind of drifting lower. It's some of the cyclicals that are doing the worst. The DAX, the most red of the regions, that's down 0.7%. It's things like chemical companies, autos. Again, really economically exposed type sectors are the ones that are doing more poorly. So if you look at the overall headline index, we are moving lower on the stock 600. So let's flip up the boards and take a look at that, down 0.4%. It was a better day for Telecom Italia. It's given up some of its gains. Finally, it's going to be getting likely, according to reports, exclusive conversations with KKR about taking over its network operations. This has been such a long deal. Are we finally getting to the end of it after KKR upped its bid? The real drama yesterday was in the front end of the UK curve. This thing has moved 160 basis points in the past quarter. That's only happened one other time in history in the past, or at least since as long as we have data, 3 decades back. We're coming in a little bit today, but we're still solidly above 5%, a level we haven't seen since 2008. And finally, it's a divide between the hawks and the bulls over at the ECB. Schnabel at a conference saying that they want to err on the side of doing too much rather than too little. Lane, who of course is a dove, saying, look, it's way too soon to be talking about September. We've already done a lot of hikes. But for now in the market, the hawks are winning out, a stronger euro versus the dollar today, Critty.
Certainly something you're going to be keeping an eye on, because at the end of the day, central banking is at the core of the trade around the world, which brings us to the Asian story. Chinese banks disappointed investors with a modest cut to its 5-year rate after some economists predicted a bigger reduction. Joining us now for more is Bloomberg's Ksenia Galushko. Ksenia, this expectation of Chinese stimulus is so important because going back to the global financial crisis, that stimulus from China helped the rest of the world. Talk to us about why this time we didn't get that stimulus.
That's right. So today's reduction in rates came in as a disappointment to market players. Some economists had actually predicted a 15 basis point cut, but that did not occur. And again, with a slowdown in China's recovery, which at first proved to be quite strong at the end of last year, fueling a global equity recovery, especially in Europe, this is showing signals of slowing down. So the economic recovery is really stumbling in China, creating concerns for global markets.
So if we don't have China that can lead the push higher in global equities, what can at this point, Ksenia?
At this point, it's actually quite interesting. So yes, we had disappointing news out of China this morning, but actually US equity futures and European stocks are actually not doing too badly. Yes, we started off on a weaker note this morning, but then equities very quickly erased those losses. And the main reason is that equity investors are actually much more focused on profit growth and also on the Fed and ECB signals, which are saying that they will pause the rate hikes and they will continue to exert more stimulus on the market as the economic recessionary headwinds are growing. At the same time, this China slowdown is a big concern for luxury stocks in Europe, because in Europe, the recovery has been led by these major luxury companies like LVMH, Kering. And if the China slowdown continues, if the consumer demand there continues to be weaker, that is going to be a major concern for European stocks.
Certainly something that is going to have those ripple effects throughout the markets around the world. Bloomberg's Ksenia Galushko all over that story. We thank you as always. And sticking with the China story, U.S.-China relations moving past months of icy tensions as State Secretary Blinken's visit to Beijing opens up paths for further communication. Joining us now to break it all down, Bloomberg's Beijing Bureau Chief John Liu. John, talk to us about how these talks actually went. If you look at the readouts from the U.S. and from China, one is far more friendly than the other. What should we know about what happened this weekend?
I think the most important thing to know about what happened is that Secretary Blinken actually came. I don't think there's anything in this relationship you can take for granted at this point. Secretary Blinken was supposed to come in February. He didn't make it because of the spy balloon. He came. He had a 7+ hour talk with the Chinese Foreign Minister Qin Gang. He met with China's top foreign policy official, Wang Yi, and he met with Xi Jinping. And so this is the highest level visit from a U.S. official that we've had in 5 years. Maybe they could have gotten military to military talks, which Washington had wanted. But even without that, we didn't get that announcement. Even without that, I think there is some level of success just by the fact that it happened.
So what now, John? Is it setting the stage for a Xi-Biden meeting?
Well, there's obviously going to be more talks. Chinese Foreign Minister Qin Gang has been invited to Washington. He's accepted. We're expecting Secretary Yellen, John Kerry, among others, to come to Beijing soon. And as you point out, a Xi-Biden meeting, maybe at G20 in September, is something we're all looking out for. All setting up for Xi to visit the United States in November when the U.S. hosts APEC. But as all of that is happening, you're going to still have these two countries wrestling with each other. We have the Chinese premier in Germany today telling business leaders that if there is going to be de-risking, it should be led by corporations. There's going to be continued efforts to increase influence on both sides. And so lots of tension still, even as talks continue.
Okay, John, thank you very much for the update there. Beijing Bureau Chief John Liu. Now, Bloomberg has learned that UBS faces hundreds of millions of dollars in penalties following investigations by several regulators into Credit Suisse's dealings with Archegos Capital. Joining us now on this is JP Barnett. JP, it honestly feels like this was a decade ago. Of course, Archegos, a lot has happened, but it's not that long ago. How bad is this for UBS to be facing these fines?
Well, it actually does feel like a decade ago. You're absolutely right there. But I think it's because we have talked about it so much that it really feels like an old story. But I mean, like, I would say it's not too bad for UBS. Of course, it's not looking great, but everybody knew that UBS will inherit all the issues that Credit Suisse, and that is the main reason why UBS got Credit Suisse on a rather cheap price. I mean, let's not forget that they only paid a couple of millions for the bank that was worth more than 15 billion Swiss francs just like a couple of months ago. So from a financial perspective, this is not something that the top executives at UBS will have sleepless nights over. The bigger question for investors, I guess, is like how much else is there in the books of Credit Suisse? And as it comes to litigation costs and expenses, you only can estimate them so far, and then you have to see what's next. And these unknowns are never great for a stock going forward. And I guess it will be an ongoing and repeated topic on the upcoming earnings calls for UBS to give color on how these matters will be solved as quickly as possible.
Well, how does UBS deal with something like that? What are the options that are even on the table at a time when, to your point, they're already absorbing a lot of these costs from Credit Suisse? Do we have to see it in deal volume, perhaps?
Yeah, absolutely. I mean, UBS has to do two things, and both, I would say, have to happen rather fast. We know it's a complicated merger, and we can't like put too much time pressure on them. But I guess like the idea for the top executives at UBS is to deal with those pressing issues first to get investors at ease. And the last messages that we saw coming out of UBS go in that direction. So with all the litigation stuff, I would expect them that they sit down with the regulator rather today than tomorrow, basically, and talk out, okay, what's the fine going to be? How can we settle this as quickly as possible? And then the matter is off the table, and then they can focus on the really tough stuff, which is the operating business, and to align that and to merge all the systems and the employees and the clients and so on and so forth. So that would be my guess. Take those litigations. I mean, you have to deal with them anyway, and as long as the number that is at the end on the bill is acceptable, they will do everything they can, I guess, to not have this issue on the agenda every single earnings call.
Yeah, certainly. And of course, then attention will certainly turn to what sort of job cuts we're going to be looking at after Amadi's opinion piece over the weekend. JP, thank you so much for that. That's Bloomberg's Jan Patrick Barnett. Now, coming up, we're going to speak to Steve Sang, director of the SOAS China Institute, on the outlook for U.S.-China relations following the Blinken visit. And we're going to catch up with J.P. Morgan's Madison Fowler on whether the stock market is set up for a second quarter rally. Is the bull market really here? Plus, Harry Colvin, senior market strategist at Longview Economics, will join us to push ahead to the BOE decision. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store. so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Progress is hard. It takes time, and it's not the product of one visit, one trip, one conversation. My hope and expectation is we will have better communications, better engagement going forward. That's certainly not going to solve every problem between us, far from it. But it is critical to doing what we both agree is necessary, and that is responsibly managing the relationship. It's in the interest of the United States to do that. It's in the interest of China to do that. It's in the interest of the world.
That was Secretary of State Anthony Blinken during his two-day trip to Beijing. The secretary there speaking simply about the progress that they are making in terms of really kind of making those icy tensions just a little less icy, or thawing at least. Joining us now, Steve Tsang, director of the SOAS China Institute, joins us with a little bit more perspective. Steve, if you look at the readouts from these two sides of these meetings, there wasn't exactly any signs that they were on the same page. It feels like the U.S. readout signaled far more progress than the China side did. What was your initial take?
Well, what struck me very much was the mature approach towards diplomacy that Blinken and the Americans have taken, and the mix of a element of maturity and element of juvenile behavior on the part of the Chinese leadership, because the Chinese were much more focused on the posturing, the lecturing of the Americans to Blinken. I mean, it's very clear from Xi Jinping's meeting with Blinken that it was mostly Xi Jinping talking and Blinken listening. For all that, the Chinese really wanted the Americans to retract from the American position before they even wanted to talk to the Chinese. Blinken has managed to use diplomacy the way that diplomacy was meant to be used, to re-establish high-level dialogue. That's really all that has been achieved, but it is not a mean achievement given the attitude of the Chinese government at the moment.
Well, how does the Chinese government then approach things like perhaps a little bit more iciness from the Biden administration, tariffs that still haven't been removed yet, relative to some of the reception or some of the attention that they're getting from corporate CEOs, the likes of Elon Musk, Jamie Dimon, and others? How is that received?
Well, that's a classic Chinese united front approach, which is that they engage as widely as they can in order to divide the other side that's being engaged, to isolate the U.S. administration and get U.S. Big businesses to lobby on their behalf against the U.S. government, for the U.S. government to change their policy. I mean, what came through in this visit is that Blinken has not made any concessions on those big issues that the United States is interested in and concerned about. And yet he still managed to have that talks all the way to with Xi Jinping.
That is so fascinating, because we've heard similar language from the Chinese premier about Germany, saying that it should be the German CEOs that take on the de-risking charge, not the government. Has that approach worked? I mean, as Kriti mentioned, you have had all of these executives coming over to China.
Well, it is more effective than we in the West like to think. I think it was Lenin who used to say famously that with the capitalists, they will sell you the rope to hang themselves. And that is, in a sense, what they are still playing out of the playbook in terms of how they try to engage with large Western businesses to appeal to their economic business interests in order to get them to persuade their governments to ease their policies towards China so that China can get its way.
Steve, this might be first getting a Lenin quote into the show. Okay, given all of that, and given just the fact that, look, that there are differences between the U.S. and China that are fundamental, things like Taiwan, for example, how do we measure progress in this relationship?
Well, I think the progress there is that things don't blow up. The big issue about Taiwan is that the basic U.S. positions and the basic Chinese positions are not reconcilable. China wants Taiwan. The United States position is that people in Taiwan must decide their own future, and the range of options available to people in Taiwan is something that the Chinese government does not accept, nor for that matter does the Chinese government accept that people of Taiwan have a right to decide their own future. It's a future for China to decide. So as long as they can keep that relationship on an even keel and avoid a conflict, it is a success.
Well, on the Taiwan front, you've already started to see a lot of investors hypothetically kind of pull out from investing in companies like TSMC, for example, on the threat of the China risk. Walk us through the way this is perceived from the China side as we start to see these massive investments in other parts of Asia, especially from chip companies, Japan, India. I believe Intel investing about $25 billion in Israel over the weekend, or announcing that at least. How is that interpreted from China that the investment is going away from the mainland?
Well, the Chinese government see that as a demonstration of American hostility. They see it as the United States being the black hand, driving all these changes in order to harm China's economic well-being and innovative progress. And therefore, they do blame the Americans for it. And that is exactly why I said, in this context, Blinken being able to do what he did was not a mean achievement, because the Chinese really want the Americans to do rather more than Blinken has done.
And walk us through then the story of just kind of how this is all done in terms of pricing. We know that China, for example, competes actively with the likes of Japan and South Korea when it comes to exporting through the rest of the world. Steve, again, what more can China or the United States do when it comes to more hostile relations beyond just this era of deglobalization?
I think the Americans are, in a sense, reining back in terms of the entrenchment of the tension between China and the United States. The changing of the rhetoric from decoupling to de-risking is intended very much by the Americans to do so. Now, the Chinese choose to interpret it that de-risking is just another name for decoupling, and therefore there isn't really any change in U.S. policy. And they wanted the Americans to demonstrate, to take actions to demonstrate that they are not actively working to weaken the Chinese economy and China's capacities to export and compete across the board. Now, reality is that the Chinese economy will go the way that it will go. It will not simply be changed by whatever U.S. policy will be, but the tension which will remain is going to make it more difficult.
Well, there have been also some signs that maybe China has turned more internal itself as well, of course, as they had for a long time with their whole tech ecosystem. Is there some degree where China also wants to be less reliant on the U.S., especially if they plan at some point to take action on Taiwan, which you'd, of course, see a big backlash from Western countries?
Oh, the Chinese have been for quite a while trying to be much more self-sufficient and less dependent on the West. So whether you call it de-risking or decoupling, it was a policy that was pursued by both sides. In fact, it was Xi Jinping who in 2013 who started the process of doing so well before Donald Trump came on the scene and announced a policy of decoupling with China. What they really want is that the Western economies, including the US, continue to be more dependent on the Chinese economy, with the Chinese economy less dependent on the West. And in the meantime, they want to increase domestic consumption and use that as a new driver for growth in the Chinese economy. They haven't been too successful there because the domestic economy is also losing steam and not doing quite as well as they would like it to be.
Yeah, on that point, I mean, the data has disappointed. There hasn't been any grand showing of stimulus. Steve, are you surprised we haven't seen more stimulus coming out of China? It's only been, there have been measures, but not as big as some economists had hoped for.
Well, that is correct, but that reflects the different kind of approach that Xi Jinping takes compared to his predecessors. Xi Jinping is not focused on economic growth or the percentage of economic growth. He is focused on making the economy strong and innovative and competitive in other ways. So he doesn't really necessarily see the need for boosting the economy when the growth rate is weakening. And he also wanted a market, but the real estate market account for something like 30% of growth in the Chinese economy. And with the real estate market being as poorly as it is, they are just not going to get the domestic economy up and running fast at the moment.
Okay, so then, kind of counter to what we've been talking about, Steve, does China need the U.S. right now? Is that part of what accounts for the timing of this Blinken visit, that internally, if you don't want to do things like encourage more property speculation, maybe you need help from people who are kind of friends, kind of not friends at this moment?
I think you put your fingers on it right there. The Chinese do still need the United States and the Western economies. That's why they are still going out to try to reach out. And that's why there's still opportunities for investments in China and for trade with China. But what the Chinese want is to do so on their terms, rather than on terms that are being laid down by the United States or other Western democracies. So, and that also explains why they are engaging so much with the top Western business community in order to get them to lobby on their behalf.
Okay, Steve, thank you so much for joining us today. Really appreciate that. That's Steve Sang of SOAS China Institute. Kriti, look, there are folks plenty worried about the Chinese economy. Goldman, for example, over the weekend, they cut their GDP forecast for the country. They did see 6%. That's now lowered to 5.4%.
Yeah, and it's really interesting to talk about kind of the ripple effects around the world, Danny. One of my favorite kind of historical fun facts, I was a history major at UVA, as you know, is simply that in 08, 09, one of the major kind of things that got the U.S. economy back on the right footing was this massive infrastructure stimulus from China, this massive investment. So I wonder to what extent the ripple effects are going to be perhaps even more crucial this time around.
Yeah, what's going to take the mantle of global growth if it's not the U.S. and certainly not Europe? Well, we're going to talk about markets coming up, Kriti, and all of this. We're going to be speaking with Madison Fowler, global investment strategist at JP Morgan. Next, can you be optimistic if China isn't giving these markets a lift? Can the U.S. take the mantle? Is this a real bull market? Lots to talk about. This is Bloomberg.
do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Global stocks decline as U.S. markets wake up from a long weekend. Concerns over weaker than expected stimulus out of China is weighing on investor sentiment. And thawing tensions, U.S. State Secretary Anthony Blinken's meeting with Chinese President Xi Jinping restores communications between the two countries after months of heightened tensions. Both sides vow to continue talking, with more high-level visits to come. And UBS is reportedly facing hundreds of millions of dollars in penalties over Credit Suisse's dealing with Archegos Capital. Imposed fines may come from the U.S. and U.K. regulators, according to Bloomberg reporting. I'm Kriti Gupta in New York with Danny Berger in London. Danny, a lot to digest. At the heart of it, it feels like this China story having real ripple effects in today's trading session.
Oh, yeah. I mean, it was really negative for Europe yesterday, and we're continuing that based off of China. The concern there is we wanted this kind of shock and awe stimulus coming from China's State Council over the weekend. We didn't get that. We also, in terms of bank rate cuts, that wasn't as much as we had hoped either. So what supports global growth right now, if not China? It doesn't necessarily look like it's going to be Europe or the U.S. Sure, maybe we avoid a recession, but even so, a second soggy day for European equities, down 0.4%. A better day for Telecom Italia, finally getting some movement on their deal to sell their networks. KKR, according to people familiar, might be close to entering negotiations with them. Then the two-year yield. I mean, this move has been remarkable in the UK. We're back above 5%, the first time since the financial crisis. There's been a lot of hot data coming in. It was labor market data last week. We're going to get CPI tomorrow in the UK, and then a very difficult BOE decision. Finally, the euro, some of that strength petering out. We are getting close to 110. A pretty clear split between the bulls, the hawks rather, I'm mixing up all my animals here, between the hawks and the doves. But we did hear from Schnabel overnight saying that it's better that they err on the side, Kriti, of doing too much rather than too little.
Yeah, it's interesting. That seems to be a sentiment around the world, and certainly something you saw overnight in the Asia session as well. I'm going to start there before we get into the U.S. price action, because to your point, the kind of hawkishness that you are seeing is something that kind of reflected even in the Australian session, for example. You saw the Aussie dollar really start to weaken based on the idea simply that the RBA minutes came out and they actually considered a pause on that growth concern, Danny, that you just laid out. It is actually the biggest weight on the Bloomberg Dollar Index today. In addition, you have the Hang Seng Index really taking a hit, down about 1.5% overnight, on this idea that the PBOC did not come through with the same stimulus that they were largely expected to by economists and investors alike. Put that together and you're really seeing it weigh on futures, down about 0.5%, 44.33 on those contracts. But then again, it comes back to the central banking story on this side of the Atlantic. Simply the idea that if you were talking about an even more hawkish Federal Reserve in the coming months and arguably years, if Chairman Powell has his way, the two-year yield has a lot lot of catching up to do. 472 on the front end of the curve, Danny.
All right, well, let's get more into these markets. And joining us now is Madison Fowler, Global Investment Strategist at JP Morgan Private Bank. Madison, thanks so much for joining. Look, I want to kick us off with a quote from Mike Wilson of Morgan Stanley, who has a bearish tilt, as you would expect him. He wrote in a note saying that if second half growth reaccelerates as expected, then the bullish narrative being used to support equity prices will be proven correct. If not, many investors may be in for a rude awakening given the very big reach for risk we are seeing. Are we in for a rude awakening, Madison?
Thank you for having me, and great question to start off with. So I think, we do have to take into context the, strong rally that we've had so far. But what I would say is when we do rely on historical comparison, when we look back at prior bear markets, when we look at the last 11 bear markets, when the S&P 500 has rallied 20% from the lows, typically the stock market tends to rally another 20% over the course of the next year. I think that's not to say it's all smooth sailing from here, and we're not necessarily calling for another 20% upside from current levels. We're, I think, a little bit more conservative than that. But I think when we look at the idea that we've all been so obsessed about recession for so long, and that stocks corrected a lot already last year in anticipation of that, that does lead us, I think, to pricing more in terms of future expectations. So when you look at future expectations, earning revisions are actually inflecting higher. And so for us, that I think leads us to believing that stocks will be higher a year from now than where they are today.
And to that point, in terms of we all expected a recession, at least one by now, did we kind of just get married to this view and we said, okay, if we haven't got one, maybe we'll get one later? Is that what's happening right now?
Sure. So I think, what's been surprising is that the economy has held up, far better than expected. It's been a stronger start to the year. But nonetheless, we are seeing, waning momentum on the back of that. You can look at manufacturing activity, look at housing, look at decline in CapEx spending. But I do think, while we have come from, this place of resilience, we do expect that slowing momentum to continue to be the case as tighter credit conditions continue to roll their way through the economy. But I think the point there is just that the market is not the economy. So coming into the year, we had this view of having weaker growth but stronger markets, and I do think that thesis is playing out.
Weaker growth but stronger markets. How long does that last, though, Madison? When we're talking about simply the growth picture for the economy, at the end of the day, you do still need economic momentum forecasted, say 6 to 12 months out, for these gains to continue. And yet, there's still a recession somewhere in the cards. Has that already been priced in the carnage of 2022?
I think that's fair. I mean, I think when you look at how stock markets tend to perform around, changing economic cycles, it's typically the valuation contraction that happens first, and then thereafter you see that declining earnings momentum, and then you see the upswing happen a bit later. And so I think that valuation contraction part is what we experienced last year when we saw the worst year for the S&P 500 since the global financial crisis, and now we've had 2 negative quarters of earnings growth for the S&P over the prior 2 quarters. And now as, I think we have this go-forward basis. Again, we're looking at earnings expectations moving higher. But I think what's even more constructive from my perspective is that this isn't a rally that is, solely focused on tech. Over the course of the last, few weeks, we've really started to see that broaden out to other pockets of the market. For instance, small and mid-cap companies are handily outpacing their large-cap peers. And then certainly when you look outside of the U.S., 13 countries out of the 48 that we track are actually also outperforming the U.S. So I think, we do have to take a broader perspective here as well.
Well, when you're talking about those kind of valuation contexts, I take your point that valuations in 2022 certainly collapsed. But from here on out, from an entry point kind of perspective, do valuations really matter? Should that be in kind of the thinking of an average investor? One of my favorite quotes came from a very well-known tech bull, Dan Ives, and he came out and said, look, if you were worried about valuations in the last 10, 15 years, you'd be missing out completely on the Facebooks, the Apples, et cetera. Do valuations matter in these next year or so?
I do think valuations matter. I think what's important to keep in mind, though, is, at what price are you getting access to that future growth? And so I wouldn't say I'm, valuation agnostic and just, holding my hand up to buy the market blindly. But I do think that there are some really compelling parts of the market where you can access growth, but at a reasonable price. So I think it's just really about being thoughtful in terms of how you do that, and then practicing alpha over beta, active management over passive.
The FT had a really good piece yesterday talking about the fact that equity 12-month earning yield, 3-month bills, and most investment-grade bonds are all basically yielding the same thing. What place does cash have in a portfolio right now?
Great question. I think what we need to keep in mind is, where in the world you're investing in, first of all. But I think certainly in the U.S., as we're seeing the Fed inching closer and closer towards, finishing this hiking cycle, whether it's one more hike or two, it seems very obvious that reinvestment risk is becoming, even more real now compared to where it was a few months ago. And so I think while some of those cash yields look really juicy right now, and certainly being in cash last year while central banks started to hike was really compelling, on a looking forward basis, I think certainly that's going to grow more challenging, and so we're looking really, I think, to extend duration, specifically as economic growth starts to, I think, get more sour.
Right. Okay, Madison, thank you so much for joining us. So cash isn't trash, but maybe, push it to the side a little bit. Madison Fowler there of JP Morgan Private Bank. Now coming up, we're going to continue the conversation over the state of the U.S. and U.K. economy. We're going to be speaking to Harry Colvin, Senior Market Strategist at Longview Economics next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now, joining Kriti and me now is Harry Colvin, Director and Senior Market Strategist at Longview Economics. Harry, thanks so much for joining. It might be a little bit more calm this morning, but I'll tell you, the UK two-year yield yesterday was really remarkable. We're back above 5%. We've got CPI, we've got a BOE decision this week. How worried are you about the UK?
Well, we're pretty worried. We're in the midst of a generational interest rate shock, not just in the UK, but in the US and, of course, across Europe as well. And it's going to cause a lot of pain, particularly in the housing market. And if you think about the way we run our economy, sadly, we've got one of the worst economic growth models in the West, in the UK. We rely on rising house prices, asset prices generally, strong positive wealth effects, and then more appetite for consuming and, in particular, borrowing. It's a terrible way to run your economy, but that's how we do it. So when money tightens up, we have problems, particularly in housing and with the consumer.
So Bloomberg Economics has this piece out basically saying if we go to 6% from the BOE in terms of rates, we're going to get a recession. It's going to bring GDP in by about 2%. Does the BOE need to err on the side of caution? Again, just given that transmission mechanism we were talking about with mortgage rates.
Absolutely. They've over-tightened policy, so has the Fed, so has the ECB, and they're set the stage for a recession because all of these central banks have what we call Volcker religion. They'll do anything to fully purge inflation from the system. They're paranoid about repeating the after-Burns years of the 1970s where they didn't squeeze inflation properly. And so recession, in their mind, is a price worth paying to kill inflation off.
Well, Harry, walk us through then the story of how that translates to the rest of the world. You're seeing this kind of extremely hawkish action in the BOE. You're seeing it in the Bank of Canada, the RBA, and certainly around the world to lean hawkish. To what extent is that going to kind of influence the Federal Reserve that is kind of the contrarian right now and talking about pausing?
Well, they skipped, didn't they? But let's not forget it was a hawkish skip, and there were 2 more 25 basis points hikes in the dot plot. So they want to keep going. They want to keep money super tight. We've got an inverted yield curve. We've got very tight credit conditions. And importantly, we've got a turn in the credit cycle. And therefore, we're going to increasingly see a turn in the economic cycle. So I think the stage is set for recession in the US, probably beginning later this year, if not early next year.
Well, isn't that recession then kind of priced into the market then? Talk to us about the translation into kind of the longer term thinking from the Federal Reserve as we're talking about not cutting rates for perhaps years, at least that's the phrasing from Chairman Powell. What may have them change that view?
Well, firstly, it's not priced into markets. We had the low in the equity market in the US in October. And if you look through the history of recessions, there have been 15 recessions since and including the 1929 to 31 depression. And in almost all of those, the equity market bottomed either during the recession or after it had finished. So if you want to believe we've priced it in, you have to believe that that was all done in October last year, potentially a year before the recession even started. And I'd say as well, it's not priced into the rates market, certainly not priced into the credit market. We've got high yield credit spreads trading at around 500 bips. Really, we want to see them at about 1,000 to feel like the credit market's priced recession. So that's, I think, the unique opportunity for asset allocators today, that we've got a recession coming, but it's not properly priced.
Yeah, even triple Cs, I mean, the junkiest of junk bonds had a rally last week. What does the default cycle then look like in your mind?
Well, it's potentially a large one because we've got a lot of zombie companies in the US. We think there are about 10% of the listed corporate sector that are zombies. These are companies that have been unable to cover their interest expense with their EBIT for 3 consecutive years, and they're going to be struggling in higher rates. So that's the risk if you want to create a really bearish scenario. But probably it's going to be a relatively mild recession, and I say that because the US is structurally much stronger than it was, say, 10 years ago.
I mean, look, I'm still kind of getting over the fact you're saying that everyone has over-tightened. Basically, all the central banks have over-tightened. So what do we do from here? I mean, is it too late then when it comes to central bank policy? Do they need to start cutting?
I think it's too late and they can start cutting, but I doubt it's going to make a lot of difference, which is always the case as you go into recession. They start cutting, but the recession dynamics have already started to emerge and unfold. The dominoes have started to fall and the dynamic is at play. So, and then it takes a whole cutting cycle usually to properly stimulate the economy and cause it to reaccelerate. So I think all the tightening's in the pipeline, it's too late. And what we do is we move underweight equities and overweight bonds.
Well, Harry, then talk to us then about kind of the issuance or the deluge of issuance that we're expected to get over the next weeks and months from the Treasury. There is a question in these credit markets about just how digestible that is. Is that something that you're worried about when it comes to these credit conditions?
Absolutely. I mean, I think you've got to remember one of the key reasons we've had a very strong rally in risk assets, particularly in tech, is because we've had all this liquidity as the Treasury's been drawing down its balance, the TGA. This is its balance with the Fed. So look, it's going to have to rebuild all of that, and it does it by issuance. We're going to get about $1.3 trillion of net new issuance by year end, and that's going to suck liquidity from markets. So this is a really key reason to be bearish on equities and other risk assets over coming months.
But Harry, isn't the market already dealing with a liquidity story? We've been talking about these kind of credit liquidity for, I want to say, at least a year and a half before even the banking turmoil came about and before the Federal Reserve was way farther into its rate tightening cycle as it is now. Why is this liquidity warning different than the others?
Well, the liquidity warning I'm really talking about is the Treasury sucking liquidity out of financial markets. That's what I'm referring to, and that's a big problem. I think perhaps the liquidity you're talking about is the signs that we're seeing junk bonds failing. We're seeing some failures at the margin. We've had a little mini banking crisis a few months ago, and I think there'll be much more of that coming, particularly given the outlook for the credit cycle and just how tight credit conditions are in the banking system.
Harry, I feel like after this conversation, I need to go into my portfolio, make some changes. Yeah. Harry, I'm afraid that's all we have time for. Thank you so much for joining Harry Colvin there, Director and Senior Market Strategist at Longview Economics. Now, coming up, we're going to take a look at some of the market-moving events you need to be watching out for this week. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Now let's get a quick look at what's ahead this week. We're going to be hearing from Fed Presidents Bullard and Williams later today. And then we're going to get the latest inflation print out of the UK on Wednesday. The data has been hot. Plus, it's a busy day on Capitol Hill, Chair Powell's congressional testimony, and a Fed nomination hearing. And then a Bank of England rate decision coming on Thursday. Bloomberg Economics says if they go to 6% this year, we're going to get a recession. And then finally, rounding out the week, we're going to get PMI data from the US, UK, and Europe on Friday. But Kriti, just this week with Bullard and Williams, I mean, those are two central bank speakers, two Fed speakers known to be a bit more on the hawkish side. If you're Harry Colvin, who we're just speaking to, he's probably going to be cringing watching them because he says the Fed has already done too much and they should be cutting.
And we know, of course, James Bullard, to your point, yes, very hawkish, but also kind of known as almost front-running what the Federal Reserve can do. So markets very sensitive to what comes out of his mouth. But Danny, I got to say, the BOE really in focus, I think even stateside, more so than usual, simply because we've had this deluge of central bank decisions that have really surprised to the upside, the Federal Reserve notwithstanding. I wonder what kind of precedent the BOE sets here.
Yeah, and look, when we talk about long and variable lags, presumably those are shorter in the UK just because of the state of mortgages here, the fact that they're usually around a 2-year mortgage, not like 30-year of what you have going on in the US. So if inflation isn't yet coming down, how long are the lags really? Do they need a hike more? And do they risk really doing some damage to this UK economy?
I'm glad you brought up the housing piece of the equation because, of course, there's that structural difference between the U.S. and the U.K. But something that stood out to me in Chairman Powell's last press conference was when he talked about the housing market. He actually said, look, some of these shelter costs, they're coming down, but he thinks they're bottoming out. He's actually preparing himself for perhaps another leg of prices getting higher, reversing perhaps some of the softening that we've seen in the housing market, which, if you're worried about inflation being led by those shelter costs, that isn't exactly a good sign from the chairman of the Federal Reserve. So, Danny, that's something that's kind of on my watch list there.
Oh, I gotta buy a house in New York at some point. This is not good news for me, Kriti. Do you have anything else to cheer me up this morning?
You, me, and everyone. I think we all wanted a little bit of New York City real estate. I don't have anything to cheer you up, but I do have some pre-market movers that I want to put on our radar here. A story that's coming from the other side of the Pacific, I should say. Alibaba specifically, seeing a little bit of a shakeup in their leadership. Shares down about 2.4% when you look at their ADRs here. Naming a new chairman, replacing their old one. Now, essentially the idea here is that although that is a shakeup that kind of favors one of Jack Ma's kind of close confidants, a lot of the street is saying, look, we got to see the growth first before we really kind of install a good chunk of confidence in this new restructuring.
Yeah, we're in the post-tech crackdown era in China, which, as you say, has been difficult for Alibaba.
It really has, and it's not just Alibaba alone. Then you go to around the world to other tech companies really kind of butting heads with the respective governments, which brings me to Adobe shares down about 1.3% in the pre-market. Also taking a hit this time, the FT reporting that the EU is preparing to launch an antitrust probe with the Adobe Figma deal. It's about a $20 billion deal set to take place later this year. And again, the European Union coming out very aggressively with those tech concerns.
Yep. Of course, the one right before this was Google being hit with an EU charge over its tech dominance. So, the EU leading the way here when it comes to some of this regulation.
They're leading the way in regulation, but Europe is also leading the way, I want to say, in kind of innovation and diversifying a little bit. Stellantis is a great example this morning. STLA is your ticker. Their shares actually down 2.8% as well. Sentiment is not great, we should say, on both sides of the Atlantic on the micro front. But essentially, they're partnering with Foxconn, which we know as the major chip supplier to Apple, to create kind of a semiconductors company. This would be kind of based in Netherlands, but really trying to amp up their exposure to the auto space and how they can kind of enter the future when it comes to the auto story, Danny.
There's a lot going on with chip manufacturing right now. Intel yesterday announcing they're going to get some German subsidies and going to open up a plant there. So they're spending more. It's everyone trying to chip away. Oops, I actually did not mean to make that pun, but chip away at some of these supply chain issues.
Yeah,
bad.
No, it's okay. It's an appropriate pun, I think, for 5:55 in the morning, New York time. I also just got to very quickly put on your radar, Danny. We do have FedEx reporting after the bell, so we've seen a lot of tech-heavy stories right now, down about 0.2%. But at the end of the day, we are going to be looking out for those earnings and seeing just how much margin improvement they have given their own restructuring.
Yep, absolutely. A pandemic darling. Is everyone still ordering stuff online? I think the answer is probably yes. Anyway, that's it for Early Edition. It was great to be with you today, Kriti, and to join you on surveillance. And still surveillance, more is ahead. They're going to be speaking to Brown Brothers Harriman and JP Morgan.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
This is Bloomberg.
I really feel the markets are kind of getting divorced from the Fed.
The issue really is the lagged effects of policy.
I think that the Fed is going to have to continue to raise rates or stay higher for longer. The market is not pricing that in.
There are extremely few historical examples of the Fed hiking, pausing, and then resuming hiking.
I think the Fed has to sleep with one eye open well into the future because the economy has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on Tuesday, 4-day work week on radio, on television. Farrow on assignment, one of 3 islands, somewhere warmer, better, prettier, cooler, fancy.
How do you get one of those assignments?
I don't know. I'm looking for that. I'm looking for that assignment. Anyways, John's on a wonderful assignment. We're with you today. A really interesting day, to say the least. We've got a lot to talk about. Smarkets. Ben Laidler will start us off here on the equity market. It's not an equity-centric show, but we're really going to look at the stock market. And Lisa, with the futures negative 19, a little bit of a pullback. The single best sentence I heard in global Wall Street literature this weekend, everybody publishing, was Stuart Kaiser. It's Citigroup, yet here we are. And boy, is that the feeling of the bulls and the bears. It's like after the Fed, here we are.
And even though it seems like perhaps the FOMO trade feels a bit frothy, there still isn't necessarily anything to pull it lower. And that was what Stuart Kaiser's point was. He doesn't really see any obstacle for it to be going even higher. So I'm wondering, are we there yet at the point where bears have fully capitulated and we've gotten a more balanced? Okay, well, that's sort of the key question right now. Have we gotten a bit over the skis with the AI trade, or does it have legs that can keep going regardless of what the Fed does?
Or could it be something else? And that'll be our theme here through the morning. Again, Ben Laidler, who's a confirmed bull, will join us here in a moment. Across all of the data, it's sort of a churning market here. Of course, we saw the Secretary of State in China. That was a drama over our long weekend, and it seemed to be constructive to get to more talks.
It was constructive, although a lot of questions around the substance, especially as lawmakers head to Detroit to question Ford and GM around supply chains and resilience, this whole idea of not decoupling, but sort of making supply chains more resilient. How do you parse that out at a time of such incredible competition between the two nations?
Soccer talk with John Farrow, we can do that, where it's petrodollars buying into English football, among other things, and the FT had it, Bloomberg has it this morning as well, but the Financial Times, Arash Massoudi and Simeon Kerr reporting, this is really interesting to me, Abu Dhabi, they're the rich ones with oil, looking at Peter Orzag's Lazard, and of course they walked away from the deal, but nevertheless, You wonder if that's the future here of global Wall Street.
There was also a story about Canaccord. There's this pressure right now on investment banks, which is basically revenues are going really down. There aren't the same kind of deals that there were, say, pre-pandemic and as they were yesterday, as they were last year. So at this point, how do you move forward at a time of such competitive pressure, margin pressures, competition, and some of these smaller boutique investment firms looking for perhaps not only job cuts, which Lazard did announce back in April,
10%.
but also some sort of perhaps cash infusion.
And what's interesting to me, folks, this is really important, is the calendar of discussion. Lisa, I think we're having an end of June here. October discussions is how I'd put it. And it's underscored by, at least the interest of Abu Dhabi, the ADQ Wealth Fund with Lazard as well. So that'll be some of the themes we'll look for into July. We're going to do a brief right now. It's going to be a brief, but it centers around 400 Fed speakers between now and Friday.
There are a lot of Fed speakers, and perhaps they take on new importance after Jay Powell said, listen to what they have to say, not what I have to say. 8:30 a.m., the data dump, U.S. building permits, U.S. housing starts for May, and the Philly Fed non-manufacturing activity, also the economic indicator of FedEx earnings after the bell, which always is going to be interesting. I'm watching housing building permits because it gives you a sense of how much of a recovery and how much demand really is picking up in this sector. To your point, Tom, Fed Speak today includes it a half an hour. St. Louis Fed President Jim Bullard, he's in Barcelona, also evidently on assignment. 11:45 a.m., Fed Vice Chair for Supervision Michael Barr and New York Fed President John Williams are speaking at the Governance and Culture Reform Conference of the Federal Reserve. Very curious to hear what they have to say about banks there.
And sometimes they speak there and they talk about banking, but they talk about things away from monetary policy. But I would really like to hear John Williams of the New York Fed reaffirm his belief in a low R-starred, because the zeitgeist I'm getting, including from Jerome Powell, is maybe the lower R-starred is a higher R-starred. That would be the key thing today for me.
That the end rates that we will end up with end up being significantly higher than they have been in the past. It's a real key existential question underpinning the market. And today, on the China front, Tom, to your point, German Chancellor Olaf Scholz is hosting Chinese Premier Li Qiang in Berlin. That's at the same time that 4 U.S. lawmakers head to Detroit to talk with Ford and General Motors CEOs about perhaps moving supply chains away from China, particularly having to do with electric vehicles. I just am curious how this tension evolves if you have the sort of diplomats coming out trying to make peace, but the political rhetoric is such that you are moving toward a more hawkish kind of feel, regardless of what the diplomats say.
All I can remember is John Lawler, the CFO of Ford, visited with us here a few days ago, folks, and he said, basically, we can't make enough Broncos. It was just that simple. They can't make enough of the fancy car. Thanks, Liz Ann Saunders, for sending in a photo of her gorgeous antique Bronco. So she was born after the Bronco. She doesn't remember that stuff, but she has like out of Hollywood, the big tires, and it's a manly car.
Are you jealous?
Liz, I'm very jealous, to say the least. Futures -18, Dow futures at -130. The VIX 14.54 after the 13 print, showing the state of this bull market. I need to mention BitDog, 27,000 here. Let's make it 26,700. The yield space is really, really important. I'm going to go to 30-year bond. I'm not in the 4% watch, but 3.88% of the 30-year, up 3 basis points to 10-year, elevation in the 2-year as well. And that's about it as well. West Texas, $72, a little bit on oil, and currency market I can't make sense of. Maybe we'll get some help on that later. Euro dollar, 109.29 off of the Lagarde meeting last week. Let's get to it for a 4-day work week, and we start strong with Benjamin Laidler. He's global market strategist at eToro. And Ben, I look at what we've got here, and you say very simply, it is foundations firming within the bull market. What are the foundations of your belief stocks higher?
Yeah, I think this is very fundamentally driven. We've got a U.S. economy which is going to grow 2% this quarter. Recession risks have been pushed back. Earnings growth forecasts have doubled in the last 3 months. Absolutely the opposite of what I think the bears were looking for. We've had 11 straight months of falling inflation. Break-evens, 5-year break-evens are at 2.3%, which is basically exactly where the Fed wants them. Consumer inflation expectations, we saw the latest numbers on Friday from the University of Michigan survey plunging. I think this is opening up. This is doing 2 big things. This is giving companies, relieving the pressure on their profit margins, PPI is running 4 points below CPI at this point, and it's giving consumers purchasing power back. Wage growth is now running above headline CPI. So I think this is this sort of Goldilocks scenario. And then on top of that, we now have this capitulation of investor sentiment, which I think has just given us this sort of latest leg up in markets.
Have the Bears, I should say, fully capitulated? You talk about how this has been driven or turbocharged by that kind of short squeeze, perhaps. Is it over?
No, I think this is the sweet spot. I mean, our sort of long-term investor sentiment index is now neutral for the first time in a year and a half, so it's a long way off positive. And this sort of capitulation, you've really only seen it happen in the last sort of couple of weeks, whether that's the AA Retail Investor Sentiment Survey, whether that's the hedge fund positioning. It's been very, very recent. This is the sweet spot of people capitulating, beginning to chase this rally higher. There'll be a point in time where we get sort of worried that it's all sort of overbaked and overdone, but this is absolutely not it.
Ben, will this rally continue to be fundamentally driven if the Fed comes through with 2 more rate hikes, as they've promised to do later this year?
So the markets are fighting the Fed, as they've frankly been doing all year. It's just a symptom of the sort of data dependence outlook that the Fed has and that investors have. I think the incentives are different. I think the market is more aware of the upside risks and is happy to maybe look through maybe 1 or 2 more hikes. Whereas the Fed, I think, is going to be hanging on till absolutely the last moment. They don't want the market to loosen financial conditions off prematurely. And I think that's where you're getting this sort of conflict. But to answer your question, I think markets are forward-looking. They know that we're much closer to the end of this cycle than sort of we are to the beginning. And they're looking for the next chapter here, which is that, we get this relief from interest rates and we get a firming of growth expectations.
Ben, I want you to push against one of the bears out there, and you do this with such grace and character that I know you're not going to take a shot at Mike Wilson of Morgan Stanley. His core theme is we get a more rapid disinflation, and that brings nominal GDP down and revenue growth down. Not so much push against that, but simply what is your decades of experience about if you have a disinflationary tendency at the top line of income of the income statement, do you actually get a diminishment of revenue growth?
So I think that's going to happen. I probably just disagree with the magnitude, but I think there are 2 huge offsets here. So one I alluded to earlier, one is profit margins. Yes, you're going to get less revenue growth, but I think you're getting margin relief today. I mean, just the numbers out of Germany this morning, just to throw one number at you, producer prices in Germany in the last 8 months went from 46% to 1%. You're seeing a mini version of that in the US. That's massive relief to corporate profit margins, everywhere in the world. So that's one. That's a huge offset to less revenue growth. And 2 is I think this less growth will also bring lower inflation or bring lower bond yields. It'll bring lower interest rates. And I think that gives room, that gives some further headroom for valuations to rise. Maybe slightly less for sort of big tech, but certainly more for, the cheaper bits of the market, whether that's sort of cyclicals in the US or, places like Europe and Japan, which have frankly been the leaders this year.
I look, Ben, at the idea here of rotation. We are all, weaned on rotation in a book. And certainly, I guess there's beginning to be a broadening and rotation in the market. But with the post-pandemic and supply and demand dynamics of the bigger picture, do we not get traditional rotation in the Laidler bull market?
Listen, I think steady as it goes. I mean, I'm very happy to stay with those sort of defensive growth names, primarily big tech and, things like healthcare, because we're not out of the woods yet. I think, we've still got to get the Fed off pause and cutting interest rates. I think we're maybe, 6 months, away from that. That for me is the real trigger for the next bull market, semantics aside about, plus 20% and all that. So I think big tech and those defensive growth stocks still have further legs. I wouldn't get sucked too far into the rotation at this point, because I think most of the growth slowdown is still to come. I don't think it's a recession. I think it's going to be fairly mild, but it is ahead of us, not behind us.
Ben Laidler, thank you so much. It's hugely valuable with eToro this morning. They're on, I guess, a cautious tone to a second leg of a bull market. That's really the heart of it. Is what shifted here, Lisa, to me is Is it a bull market? Is it a bear market? Has shifted to, okay, it's a bull market, but now what? And where's that second leg? And that's what we're seeing from the equity bulls out there like Stolfus, Kaiser, and Laidler.
You mentioned Mike Wilson, and I love that he said, we've been so wrong when it comes to earnings, or not the earnings, but in terms of the market's response. And so they redid all of their numbers with different parameters and really scrutinized this and came to the conclusion they're still bearish and they still see declines.
Well, bring up the full screen here on Mike Wilson that we've got, Lisa. I think we've got a full screen here this morning on Mike Wilson.
Yeah. I'll read it for you. Given our fundamental view on growth, we find it hard to get on board with the current excitement. If second half growth reaccelerates as expected, then the bullish narrative being used to support equity prices will be proven correct. If not, many investors will be in for a rude awakening, given the very big reach for risk we are seeing. I can tell you, just from personal experience, there are a lot of people that are going to shrug that off and say, he just missed it. However, there is a question. We just had the longest weekly winning streak for the NASDAQ composite going back to March 2019. We are looking at questions around whether people have priced in endless returns for the AI promise.
Abramowitz with the save, Bramo with the save. I couldn't read the screen. The camera was so damn far away from the screen, I couldn't read it. Bramo with the save there on the important Mike Wilson quote. It's a good way to start it here. 4-day work week. That is just a joy to that, isn't there? 47 Fed speakers today. Stay with us. Sebastian Page at 7.
Was going to keep rate World Cup. This is a 3
as the economic picture does.
The OK is getting ready to make.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
My hope and expectation is we will have better communications, better engagement going forward. That's certainly not going to solve every problem between us, far from it. But it is critical to doing what we both agree is necessary, and that is responsibly managing the relationship. It's in the interest of the United States to do that. It's in the interest of China to do that. It's in the interest of the world.
The Secretary of State of the United States jump-starting things in China. Lisa, I went to Shanghai once, and we decided to live large, and we stayed at the Peace Hotel, and I had the immense honor of staying in a room. They have 5 or 6 national rooms at the Peace Hotel, the India room, the China room, which you can't get in, the government owns that. And I was in some British fake Tudor Henry VIII room. And that is the room Kissinger was in the night before they snuck to Beijing in 1970, whatever, with Nixon. Was this the same? I don't think so. But it was pretty cool. what Blinken did.
Well, this is drenched in history for sure, although he wasn't really greeted by much of anyone. There wasn't much of a reception for him.
Did you see that? Yeah.
At the airport, except for a couple red carpets that looked like red lines, perhaps. It was sort of metaphor. And there's this question going forward of whether there was anything achievable coming out of these talks other than simply not escalating, which perhaps is a victory, at least for some in and of itself.
Meet and agree, the Secretary of State in Beijing getting off the airplane, sort of like the way Terry Haynes gets off the airplane at Reagan here, back when he's coming in from Dallas, DFW. He's founder of Pangea Policy and joins us this morning. Terry, just, the basic idea, the shock of the Secretary of State of the United States at any country being shown or greeted to the country like he's coming out of Reagan. You know what it's like. You got to get from gate 10 over to gate 3 quickly, and your luggage is on the way. What was accomplished?
And those at Reagan know the infamous Gate 35X, and that was kind of what it was there, too. What was accomplished was the ability of both countries to say that they are continuing to communicate that is calculated by both sides as having the effect of diminishing tensions somewhat. I argued before the meeting and would still argue that that's largely illusory. My takeaways really are simply that China sees the United States business community as as its friend geopolitically, and will continue to try to push that relationship. That China also is pushing the United States to what they call recalibrate its relationship in Asia. In other words, kind of back off and agree that Asia should be a Chinese lake entirely, which is an absurd proposition to the many countries who are our allies there. Thirdly, there's no military communications, and fourthly, there's no mention of Ukraine or Iran, for that matter. So we've got communication, but we don't have a lot of communication, and we certainly on either side don't have anything to show.
Terry, this is the political tension right now. Perhaps it was a win for President Biden in terms of not escalating any tensions further, creating some sort of open lines of communication. Was it a win when it comes to the politics domestically of a nation very much growing hawkish on China, and some calling for some sort of decoupling, which this president has pushed back against?
Well, I agree that normalization of communications is a win for President Biden regardless. I think that's very true. At the same time, we don't get much more than that. Not much has been gotten. Secondly, my contention would be that the United States policy towards China actually started to flip in, say, 2016, 2017, even before Trump became president. And it is among the most bipartisan and probably the most bipartisan policy area that we've got in Washington. So that's not going to change either. The vast majority of Washington wants communication with China. The vast majority of Washington also does not want a situation where we're either getting rid of our own geopolitical interests or putting our allies in more peril as a result of that.
One of the lines,
we're not doing that right now. So.
One of the lines from Tony Blinken's press conference after the meeting really stuck out, at least in a lot of the talk shows over the weekend and yesterday. He said, "We remain committed to our one China policy with the 3 communiques, the Taiwan Relation Acts, the 6 assurances. We do not support Taiwan's independence. We've made it clear that we oppose any unilateral changes to the status quo by either side." Is that controversial, Terry? And how is it being sort of spun the day after?
Well, it shouldn't be controversial, because what Secretary Blinken is doing there is really underscoring that United States policy since 1979 in the Taiwan Relations Act remains the policy of the United States government. And there's been a lot of concern, a lot of understanding and misunderstanding around that over the past few years. That frankly have been aided and abetted by both President Trump and President Biden in past statements. So, what what Blinken's trying to do is put a floor under that by saying, look, our policy is as it was, and it continues to be. Make no mistake about that. Clarity is good.
Jerry, I want to link this to our economics and our corporate relationships with China. Catherine Mann is at the Bank of England. She's one of the great American international economists. And Kathy Mann of MIT and Brandeis makes very clear that we have a codependency with China. We need them economically. They need us. She owns the high ground on the Trans-Pacific codependency. What is the relationship in these discussions in your Washington when they observe Tim Cook living that codependency at Apple and bipartisan presidents saying, no, we don't want to do that? How's that work?
Well, the vast majority of Washington understands the codependency, frankly, doesn't want to upset it. I find the whole war of rhetoric here, whether it's decoupling or de-risking or anything else, to be a little overblown on the street. Nobody's talking about removing Americans or American business from China. What China is trying to do at the simultaneously, though, is trying to attract and continue to have in American business and American investment, while at the same time making the terms under which non-China investment will exist to be more onerous than it already has been. But I don't see the United States as trying to take that away.
Terry Haynes, thank you so much with Pangea Policy today on this historic trip of the Secretary. Lisa, I don't know where to go with this. I mean, I look at, the place I live, it's a 6-floor walk up, and down at the bottom are the boxes from everybody. And you look at the outside of the boxes. Which ones don't say made in China? I mean, very few, to be honest.
One of the offspring came home yesterday with a Nerf gun, and we quickly found out that it was also made in China. I will just say this. This is something that Tony Blinken highlighted pretty much in the forefront of his discussion, saying that de-risking is really the only logical way to go. Decoupling is not possible or even plausible, given the fact that trade in the past year has been higher than ever before between these two nations. It is not diminishing. It's quite the opposite, which is the reason why I'm curious about the business tensions. They need to stay in China. And a lot of the political tensions where it's kind of pushing back.
But you don't mention the military tensions as well. My high point of the Bloomberg Invest conference, yes, it was speaking to Nassim Taleb, but my high point was Anne-Marie Horton's piercing conversation with the retired Admiral Mike Rogers about the trans-Pacific realities, and I'm talking north-south from Japan down to Singapore, and our build-out of our new Pacific Rim capability.
And I wonder how much that's also underpinning some of the discussion here, because a lot of the allies of the U.S. have said, when you have this kind of tension, mistakes happen. When you don't have the military leaders talking with one another to try to offset some sort of accident, that's when there are mistakes that can happen that could potentially be catastrophic on a military front.
Help me with a data check here. I'm looking at dollar weaker, DXY holding above a 102. I'm going to call it a resilient dollar, but nevertheless off the recent peaks. Yen doesn't go through 142. That's a big deal to me. Japan is under-discussed and very important right now. And the euro, Lisa, 109.
I'm watching just the fact that yields are creeping to the highs that we've seen since, that's just this ongoing grind higher. And to me, that's the collision course of what we're seeing with respect to the dynamism in the tech trade.
After the Fed meeting, the 2-10 spread, a negative 94 basis points. Fed speakers today. Coming up, perfect timing. Claudia Sahm on the Sahm rule.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Bloomberg surveillance on a Tuesday, 4-day work week here in much of America. We welcome all of you. John Farrell, Lisa Bramwitz, and Tom Keene. John Farrell on an important assignment right now. Lisa Bramwitz and I dealing with a data check that's sort of boring and sort of churning is well, and it's sort of there. And like Lisa said correctly, yields is probably the place to go. What's credit doing? Do you still have magical corporate and high yield spreads?
Well, there had been this sort of steady grind lower, and now people are sort of reassessing whether it's gone too far. But I'm looking right now at just high yield bond spreads, and they're at this narrowest, going back again to right before some of the banking concerns started up again. I would say that there is something interesting in the data this morning, which is there is a more marked, more pronounced direction lower in stocks for the first time in quite a while. And this comes after a really long run, 8 straight weekly gains on the NASDAQ. Is this a pause? If it's a pause, is there a reassessing going on? Even to Ben Laidler's point, how much more does another leg of the bull market have? If it is just a singular development in a cohort of stocks and not necessarily more uniform.
To give you an idea, folks, and I'm not going to show this on TV because on radio people would drive off the road, but to Lisa's really, really important question, on the Standard & Poor's 500 on a percentage change from where we are right now, the center tendency is about a 4% pullback, and we're nowhere near that right now. Just, there's some quick math you can do on this. And what this means is there's been a moonshot really since the last week of May, I'm going to say, a moonshot from 4,100 up to 4,400, one of our themes through the morning. This is a joy. It's a joy always to speak to Claudia Sahm. She's founder of Sahm Consulting, Bloomberg opinion columnist, and former Federal Reserve economist. But far more, when you're that young and you come out of Michigan and you're codified with a rule in your name, there's very few people in the economics game that can say that. Claudia, where did the Sahm rule come from? Was that a paper you did in your spare time on a trip to Europe and said, I think I'm going to come up with a rule? How did the Sahm rule get invented?
The reason the Sahm rule exists is it was part of a policy proposal I had to automatically send out stimulus checks during a recession and to calibrate, how much you send out, how often. So it really was a sidebar to the policy proposal. It's turned out to be considered relatively useful to people watching recessions, but that was never the point of it.
The Heritage of Michigan with Betsy Stevenson and others there with Claudia Sahm. The Sahm rule is now full front and center. Colby Smith writing it up in the FT 10 days ago. How many states are in recession based on the Claudia Sahm rule?
Right. Well, there's different ways you can calculate it at the state level, but somewhere around 10 or less states are in a place where their unemployment rate at the state level has risen more than 0.5 percentage point. So that's kind of the rule at the national level. We're not calibrated at the state level. And yet I think it's a good exercise to look under the hood and see how various states are doing in terms of their unemployment. And a big one within that group that has, this higher increase in unemployment is California. and that's a big state.
If you do look at some of these pockets of pain and then you look at the overall aggregate, does it make the overall aggregate look worse or better? Because some of the increase that we've seen in unemployment have really been driven by a few pockets of pain.
Right, and that's a thing to look at in a state like California. There's been some very specific areas of distress. So you think about the tech sector, which is important to California's economy. And the question now is where we see these pockets of stress. Do they spread? Do they resolve themselves kind of locally? And right now that is we can't know that yet, but that's something to be watching. It's that spread that could eventually push the whole economy into a recession.
A lot of people have said that we can't necessarily get a recession and we can't necessarily get unemployment creeping that much higher if you have consumer spending where it is. You say it's not a mystery. So what is this non-mystery telling you in terms of how long it can continue?
Right, so it's really careful when we look at various numbers to understand who's actually measured and how they're put together. Something like GDP, something like personal consumption expenditures that we look at, that's reflecting mainly a lot of high-income individuals who are spending. Whereas when we look at something like the unemployment rate, everybody counts equally. So I think it's where GDP, there's like this tension between consumers keep spending and spending, but that's in a setting where these data tell us a lot more about someone like Elon Musk than they do a Walmart cashier, right? So we have to be a little careful how the data are constructed. And I think that's why the unemployment rate, which is a much more egalitarian measure of what's going on, that's a good way to look, and that looks strong too.
Claudia, I'm so glad you brought up California. I wasn't aware of this, folks. I mean, I know California's ginormous, and I thought at least it was maybe the 6th or 7th global economy. If you take it by itself, I'm wrong. It's the 4th. It's the United States, folks, China, Japan, and then the 4th economy would be California taken by itself. I mean, I think the financial media and, frankly, much of economics, Claudia, gets us totally wrong. There are these dominant states that are all Florida, California, maybe New York, and I'll let you decide the others, Texas, clearly. But are those three states not in recession while others struggle? Is there something to size in America that gives us a better stability?
It's really a mixed bag at this point. Again, we're trying to figure out, is the weakness contained or has it started spreading? California is the biggest one that's up in its unemployment rates. Unemployment rates have risen notably.
I look, Claudia, at the Fed meeting. Let's turn to that if we could, and the shock and awe of it. We had two major economists say, okay, well then why didn't they just raise rates? Were you surprised that after the verbiage, they just didn't raise rates in an Arthur Burns kind of way?
I was, though I'll give them credit. This is the most hawkish pause I could have imagined, right? Going out and saying, we're going to have 2 more rate increases, that's likely. Now, likely just means that people are putting 50% or greater odds on needing to raise rates. So it's not necessarily a done deal. I'm sure there was a robust debate at this meeting about what the policy change should be. But wow, that summary of economic projections really, nailed it home. We're going to raise, and it should have been a really clear signal, forget about the chance of cutting this year.
It wasn't, Claudia, and what you hear is, yes, perhaps people aren't necessarily pricing in rate cuts, but as we heard from Ben Laidler, people are fighting the Fed. They continue to disbelieve that they're going to raise rates once, even twice, especially not twice more this year, and that they're probably done for the cycle. Stuart Kaiser saying that this is one of the biggest risks to the melt-up that he sees continuing, all things being equal. What's your probability that you assign to the Fed being able to go once or twice more based on what you were just saying? Unemployment, probably the best gauge of how strong the economy is, and it still is pretty good.
Right, but that's all the more reason in the Fed's eyes to raise rates, right? And inflation has proved sticky, right? I mean, they signaled July could be its a live meeting. We could raise again then. They have a month of data between now and the July meeting. Like, what are they really going to learn that they didn't know already? So I take them at their word for at least that first increase. But again, this has got to be hanging on a knife's edge, because otherwise, just raise rates. Like, what are they waiting for if they think that's necessary? I still think that they're going to keep on to holding the rates high. And inflation is just too high for them to be that comfortable to cut.
Which is one reason why people are really curious to hear what Jay Powell has to say. He's heading to Capitol Hill Wednesday, tomorrow, and Thursday, and he's going to be testifying first time since the banking crisis kind of arose. How much do you expect him to double down and to say, you know what, you guys are getting it wrong. We're going to raise rates further. You can't just rally into strength and expect us to do nothing.
Right, and I think, reading the monetary policy report that goes along with, when he testifies, it certainly has that flavor. There are boxes on how we think about the what's happened in the banking sector. They still are they're lying. This is very isolated. This doesn't have anything to do with interest rate policy. I think you can see in that report emphasizing these same points. So like you said, doubling down on what he's already said. And I don't think, he's not going to want to go far from that script because they really did want this to be hawkish.
Claudia, one final question. What's our history of guessing or gaming or judging the trend and the second derivative of disinflation? Do we get that right ever?
Rarely. If you go with the historical record, within, a reasonable amount of time, facing this disinflationary cycle, how to do enough, how not to do enough. Because again, this is not Volcker Fed that walked in and said, we want this and we want it now. So there isn't much to compare it to. Frankly, the Fed's forecast, especially in the out years, it's like, wow, that's pretty optimistic. And yet they could pull this off. There's still signs of it, but I think they're going to be very cautious in stepping back, even as inflation starts to fall.
It's really, really important here. And I guess it comes down to the disinflation trend. And in housing, we get housing data today. Pantheon folks, and this was a wonderful article over the weekend, they were just blistering that the housing confidence and housing certitude, Claudia Sam, is just wrong. Harsh language. They said housing in America, the hope of it is divorced from reality. Have we become too complacent about the ramifications in real estate of these high interest rates, waiting and hoping for that disinflation?
Right. Well, housing is one of the primary sectors that the Fed should be working through to get to the real economy. That's one of the most interest rate sensitive sectors. And it's been, we've seen initially a lot of optimism pulled out and now maybe more back into the market. And as with all of these pieces, the Fed cannot move the economy on a dime, right? There's a lot of going on in the pieces, but that's a primary transmission mechanism into the rest of the economy.
Claudia, thank you so much, and congratulations on the amount of work we see on the SOM rule out there in this third quarter now. Third quarter? Almost third quarter of 2023. Claudia Sam of SOM Research. I looked, Lisa, at the 30-year mortgage, and, the bottom line is it's all this blather, and yes, it's about the stock market, and, we're all broke and all that. But what it's really about here is rent, housing, what you're doing with your kids, et cetera. And the answer is, here's my scientific survey. The housing market is nuts.
Well, especially in
New
York. And this is a region by region type of market.
City by city, yeah.
A lot of people saying it's starting to rebound after getting hit just slightly. I keep going back to the fact that no one is actually paying a 7% mortgage rate, or very few people are. They're paying 5%, perhaps direct from developers. They're staying put, so there is an inventory. This is the tension underpinning a market that's been remarkably resilient and is now turning in the other direction if you take a look at home builder stocks, if you take a look at pricing.
I got the 30-year mortgage from 7.20%, 30-year bank rate, just cracked 7%. I got 6.99% right now. Critically, the long-term moving average is demonstrably higher than it was in late March, early April, and the intermediate moving average is almost up to a peak level. So it's a sustained, I'm going to call it 7.1, 7.2% mortgage rate. And where I see it, and John's brought this up many, many times, is the complete polarity between the places I look and you look are different. There's nothing for sale where I look. There's
That's the issue.
Nothing. It's shocking.
Well, every day John comes here and says, basically, if you got some mortgage rate at 3.25% interest rate, you won the lottery. Congratulations. Why would you move? And nobody is. And I think that that's really the crux of the situation.
But in England, they're now talking about a 6% 2-year mortgage rate. That's like like, we're at 5.3%, I'll say, in T-bills, 3-month T-bill, yes, 5.2% to round it up.
Yeah, well, housing,
6% 2-year fixed mortgage kills people.
Housing is not the office space market, and that's something else that we're continuing to grapple with. There was a study done by Columbia and NYU professors that showed that the implied losses for U.S. office buildings were about $500 billion, that these office spaces are about 38% lower than they were in value before the pandemic. When do we actually see that be borne out?
But one of my changed behaviors, major shout out to Cranes, which in New York City does a great job in this, is I read every single article about every single piece of real estate and the redo, the refinancing, and the workout of it. And that 38% number rings true to me. And that'll be certainly part of our theme in the back end of this year. Futures -17, the VIX 14.49. Yields up a point, 3.77%. Good morning.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
There's been a massive structural shift in terms of the capital flow that's coming into China, right? It used to be the case that people just wanted to invest in China, build manufacturing capacity in China, but that foreign direct investment from companies has slowed very, very dramatically, and that has not recovered after reopening.
Jens Nordvig, wonderful, very important book about 10 years ago on the future of the euro. He nailed that at the time. Jens Nordvig with Exante data there. Futures -17, Dow futures -122. The dollar stable is what I'm going to call it here with oil, 72.09. I'm struggling with the data check because it's sort of a churn data check. Housing data coming out today may jumpstart things, and Fed speak as well as we rationalize what we observed last week. I do want to mention Bitcoin, some real focus there. Katie Greifield's been really helpful in giving us clarity on that. Stable, 26,700 on Bitcoin. This is a joy to bring in Win Thin. He's global head of currency at Brown Brothers Harriman. Dr. Thin is very good on the Pacific Rim from his Burma all the way up to Japan, but also with a more global basis as well. Winston, when you approach currencies, what's the first pair that gives you information right now?
First of all, Tom and Lisa, thanks for having me. You know, it's always a pleasure. We've gone back a long way, and it's really always a pleasure to see you each and every time. I think dollar euro is the main pair, but to me, dollar yen has recently become to me the real barometer. Why do I say that? Well, that's where you really see the monetary policy divergence. The Bank of Japan has remained way in the dove camp, much more than anyone expected, I think, when the year started. The Fed continues to tighten and remain hawkish, and so that pair is really reflecting the monetary policy divergence. It's, in a sense, I think the question is still out on whether, it's sort of the dollar, the ECB Fed differentials and all that, and the BOE Fed differentials, but I think it's so stark, the difference between the BOJ and the Fed, that it's really what I like to look at it every day. And I think it tells me the dollar's going to get stronger.
We're going to rip up the script here, folks. We're going to talk to Win Thin here about USD JPY and EUR JPY. Let's start with the basic thing everybody on radio and TV wants. Win Thin, why should we care about the yen? Why should we care about flawed theory out of the Bank of Japan? What's a so what for our viewers and listeners worldwide?
Yeah, I mean, Tom, the Bank of Japan, I think, holds special interest because, they have been holding rates